All right. So yeah, what we are coming to do is yes, we have done a lot of things during the last 3 months or the last 2.5 months, and we decided to come and solve what additional questions to establish more understanding on whatever we have learned. Okay. I want to tell you that the question that we are coming to solve over here are not what the questions that will come in the exam. So after solving these questions, go and do your own individual studies. Don't go and rely on these questions that you are going to be seeing these questions in the exam. So you are not going to be learning anything apart from this one. Please no. We are just solving these questions to help you appreciate what the the things that you have learned so far. So do your individual studies and also do your revision. Don't rely on the questions that we are coming to solve. Okay. All right. Thank you for that. So we are coming to look at consolidation and interpretation. So we'll be at least we can solve 2 questions on consolidation and 1 question on what on the interpretation. So within the next 3 hours, let's see what we can do. All right. Consolidation is now 20 marks. First, it was 25, where they will give you some theory questions. Now it is what 20 marks, which will be purely calculation. Okay, the calculation can be either what statement of profit or loss, statement of financial position, or they can ask you to prepare both. So we try everything possible to see if you can cover things under each of them. Okay, so that is what they are going to be asking, either profit or loss, statement of financial position, or they can ask you to prepare both. So we'll be picking some questions to see if we can actually demonstrate what those issues. But what we have to know is that you cannot go to financial reporting examination hall without understanding the following things about consolidation. Okay, you cannot go to either profit or loss or statement of financial position. You cannot go to financial reporting class or financial reporting exam hall without seeing something about fair value adjustments. Okay, you can't go there and you won't see anything on fair value adjustments. Okay, they will give you something about fair value adjustments. Okay, the net asset that you are going to be calculating will be from the financial statement of the entity, which we call book values. You are going to be using book values. Then you have to fair value the asset because the person is selling. If you want to sell your car, you can't sell your car based on the amount that you bought it. No, you have to know the current value of the car before you sell. So the time that the shareholders of the investee or the subsidiary they want to sell, they have to They have to fair value They have to fair value the assets. So we'll be doing fair value adjustments there, which can be an upward fair value adjustment and downward fair value adjustment. How do you go about it? You just have to know the effect of the transaction on an accounting equation. Accounting equation is what? Asset is equal to equity plus liability. Now you are looking for only equity. So if the asset is increasing and liability is constant, it means that equity will be increasing. If the asset is reducing and liability is constant, it means that equity will be reducing. So that's what we do about the fair value adjustments. So you cannot go to the exam hall without seeing question on fair value adjustments. You have to understand them very well with the depreciation implications. Some of the fair value adjustment will be an upward adjustment. So they can tell you that carrying value was 10 million, it has not increased by 5 million. It means that the value has increased. The asset has not increased. Depreciation will also be increasing. Okay, we are going to be picking questions to demonstrate those issues. You have to also understand what we call intra-group transactions. Okay, intra-group transactions. And the common one that you're going to be seeing is intra-group trading. Okay, intra-group trading, where either the parent will be selling to the subsidiary or the subsidiary will be selling to the parent. In their individual financial statement, they are accounting for this particular transaction as a sell. But if you come to consolidated financial statement, we say that a consolidated financial statement is preparing a statement, a single statement of 2 or more entities as if they are a single economic entity. So it's just one entity. You cannot sell to yourself. It's not possible. You have a branch and you are sending goods to them, and you are saying that you are selling to them. No, you're not selling, you are just giving the goods to them to sell on your behalf. If you have items and you are giving the items to your friend to sell, you cannot say you are selling to your friend. You are asking your friend to sell the items on your behalf. So the sale made by your friend will become your actual sales. So at the group level, we cancel those things, and we have taken our time to do that. So it is on our YouTube channel, Assurance Professional School Intra-Group Trading. We have taken our time to break down the meaning of those things. Okay, we are not here to come and take those things. We are here to come and solve what questions and move on. Okay, so you have to intra-group trading. The common one is what we call the intra-group trading, where either the parents or the subsidiary will be selling to the parent, any of them. Okay, you can also have intra-group transfer, which will be PPE, transfer of PPE. Okay, where they will be saying that one person is selling to the other person. No. If you have a car that you are not using, the car is just there, and you own a branch and the branch wants to use the car, you cannot say you are selling the car to the branch. No, you just give the car to them to use. So we have to, the question will be telling that this has been sold. There was a sale of this one. We have to now reverse those things because the group is seen as a single, it just see the two entities are going to be seen as single entity. So they cannot be what? They cannot be trading among themselves. No, you cannot sell to yourself. So we are going to be looking at that one. So there can also be some issue of loan, okay, where there are going to be an issue of loan. One person is now giving a loan. No. If the parent obtain control over the subsidiary, the parent will now be the owner of the subsidiary. The parent will now assume the liabilities of the subsidiary. So the liabilities of the subsidiary is the liability of yourself. If you are going to marry, whatever the lady is having, if the lady is owing some people, yeah, as soon as you marry the lady, you are going to assume the liabilities. So you cannot say you are what? You are giving the money to the lady, or you are borrowing the money to, yeah, you are lending the money to the lady to pay. No, you are paying the debt on behalf of the lady because the lady is not your wife. Okay, that is how we go about it. So any interest received and those things will be reversed at the group level because the entity, the group is now a single entity. We cannot be having loan. The liability of the parent or the liability of the subsidiary is the same as the liability of the parent. So the parent is buying, it means that the parent is paying the what? Its own creditors back. So we have to reverse that at the group level. But in the individual financial statement, this will be like liability and asset for them. We also have intra-group balances where they are going to be having receivables and this one also be having a corresponding payables. We have to also remove that. Right. You cannot do the consolidation without having issues about associates. At this particular level, you are going to be having one associate and one subsidiary. Okay, it's possible. So you just have to understand this things. Yes, at least if you cannot do anything, the fair value adjustment, you have to master it. The intra-group trading, you cannot have, even if it is statement of financial position, statement of profit or loss, you still have issues on intra-group trading, intra-group transfer. You have issues of them. And you also have to know how to calculate the amount that the parent is paying for the shares in the subsidiary. How much or what are they paying for them? What are they paying for the number of shares that they are buying? And you have to know that it's only acquisition of equity shares that will give you ownership because you want to become part of the owners. You want to have ownership over the company. You have to purchase what shares that will give you ownership. So the question can be telling the parents acquire preference shares, please. Preference shares does not give ownership. Loan note does not give ownership. The only thing that will be part of your consideration, the amount that you are paying, is the amount that you are paying for the equity shares. Okay, that is those things that you have to know how to calculate the equity shares and those kind of issues. Okay. If you have statement of profit or loss, the question can give you statement of profit or loss. What are you going to be doing? You are going to be having only two companies, the parent and then the subsidiary. What you have to do is identify who the parent is. You are doing statement of profit or loss. You are adding two figures together. So the parent, you don't have to do any adjustment to the parent figures given to you. Identify who the parent is. Identify who the parent is. You have your revenue here. Okay. then the revenue of the parent, cost of sales of the parent, bring those ones there. These figures, you are going to be writing them without stress. You're not going to be doing any calculation to pick them. The figures are given to you over there. So just pick them and bring it over here. You have the gross profit, please. Don't bring any figure for gross profit. Gross profit is a resultant figure. If you subtract your cost of sales from revenue, you have gross profit. Administrative expenses, bring the parent own. Distribution costs, bring the parent own. Finance costs, bring the parent own. Then you go and establish when the subsidiary was acquired. If the subsidiary has been acquired for 2 years, then you bring a full year figure for the subsidiary. If the subsidiary is acquired for 9 months, we are only interested in what? How many months share of the profit that the parent is entitled to. So we only find the portion of the what? We only consolidate the portion of the profit that the parent is entitled to. So if the parent acquired them for 9 months, you only consolidate. You find only 9 months of you find only 9 months of what? Of the trading activities. You consolidate for only 9 months. The first 3 months, the parent is not going to be having any share of that. The profit or loss, we are looking for the profit that will be shared among the parent and then the NCI. That will start from the time that the parents acquire the subsidiary. So 9 months, you do 9/12 and all those things. If it is 6 months, 6/12 multiplied by the trading activities. But if you are giving statement, okay, let me count to this one. What are the workings that you have to do? The only workings that you are going to be doing is group structure. Okay, if you have statement of profit or loss, you have to show the group structure, whether you are doing statement of financial position or whatever, you have to show the group structure. Okay, the next thing that you have to do is either goodwill. Sometimes the question can ask you to calculate goodwill, or the question can give you percentage of what? Goodwill impairment. So you have to know the goodwill before you can calculate the impairment. In that case, you have to calculate the what? The goodwill. But if the question has not asked you to calculate goodwill, the question has given you the figure for the goodwill. They have given you what? The impairment figure for the goodwill. Please, you have no business to calculate goodwill. Because if you are calculating goodwill, what are you going to be using a goodwill for? They are not asking you to calculate goodwill. You are not preparing statement of financial position where you are going to be showing goodwill at the end of the year. You are doing statement of profit or loss. What are you calculating the goodwill for? The question has not asked you. You are not giving a percentage of what? Impairment. So what are you calculating the goodwill for? No. Net asset at reporting at acquisition is not needed for what? For statement of profit or loss, because we do the net asset to get profit. Now you are calculating the profit already. You want to do net asset for what? Group retained earnings is not needed for what? For statement of profit or loss. We only do those things to know the figure that will appear in the statement of financial position at the end of what? At the end of the financial year. Statement of profit or loss, nothing like NCI, nothing like investment in associates. Those things are not going to be presented in the statement of profit or loss. No, we have no business with those things. But if you are doing statement of financial position, then all the things that I've mentioned now, please, if we are not talking, we should just put our mic off. Okay, we don't want to distract our colleagues. So 1, 2, 3, I'll just take you off because we don't want distraction. Thank you. All right. But if you are doing statement of financial position, then all the necessary workings that we are going to be doing will be what? Will be necessary, because we want to know the profit that has been made after acquisition, which will now be shared among the owners of what? Of the subsidiary, which will be the parent and the NCI. We want to know the goodwill that we are going to be reporting. We want to know the retained earnings of the subsidiary, the parent. We are going to be doing that. We want to know the NCI, the portion that the parent is not buying at the end of the financial year. We want to also show that. So all the workings that you know are applicable for what? Statement of financial position. Statement of financial position, please, if you are given the question, the first company will always be the parent unless they want to trick you. The first company will always be the parent. So if you are doing statement of financial position, statement of profit or loss, just pick the parent figure, put them there before you come and establish who the subsidiary is. The subsidiary will be the second company unless they want to trick you. So you just add their figures. If it is statement of financial position, it doesn't matter when the acquisition is done. If you have sold your car to me at the end of the year, the car is mine. The car is not yours again. So it doesn't matter when the acquisition is done for statement of financial position. We are only talking about ownership. If you have sold your car to me at the last day of the year, the car is no longer yours, it's mine. So I'll have possession of the car. I will be saying that that car is mine. So statement of financial position, we don't do anything like prorating, no. We are talking about ownership. You have sold car to me, the car is mine. But if you have started business, okay, I've given you, you went to the market to sell from the morning to 12 a.m., okay, to 12 p.m., and I've given you money from 1 p.m. Any profit that you are going to be making from the day, I will have a share from only the profit that you have made from 1 p.m. to what? To the time that you closed. But the profit that you have made from the beginning, I will not have a share of it. That is how the profit or loss works for the group. But if you come to statement of financial position, whether you started from the beginning or not, if I've purchased something from you, it is mine. It doesn't matter when you started what you started using that particular thing. So statement of financial position, don't do that. You see that the parent has acquired for 6 months. So you are doing asset 6/12. No, my brother. The invigilator will laugh at you. Okay, we don't do that for statement of financial position. We do that for only profits. What is the share of my profit? That is what we want to do. All right. Please, upon all the things that we are saying, let's now pick question to demonstrate those issues. Okay, so I want us to solve only 2 questions. Okay, so the 2 questions that we are going to be solving, let me look at them. Okay, because I have to. Let's see, I have to. Please, what if in the additional information it is stated that profit and loss should be accrued evenly throughout the year? Profit or loss accrued evenly throughout the year. What they are trying to tell you that the profit is the same. The sales for every month is the same, and the expense for every month is the same. So you can prorata. That's why we do the 9/12 for profit or loss items. Okay. Okay, let's take the question number 2. I've solved the question number 1 before. Question number 2. Yeah, the person with the question, I hope you're okay now. If they say the profit and loss, it means that you should assume that profit every month, expense every month is what? Is the same. So if the revenue is 12,000, it means that every month the revenue is what? 1,000. So it means that it is accrued evenly. It is the same every year, expense. So that is why we do the 9/12 for profit or loss items. That's why we do the 9/12 for profit or loss what? Items. Okay. Let's come to question number 2. Someone should read that for us. All right.
Okay, question number 2.
All right.
Below are statements of profit or loss and other details of 3 entities: Aflao, Diepe, and Denu for the year ended 30th June 2015. Statement of profit or loss for the year ended 30th June 2015. We have revenue, cost of sales, gross profit, operating expenses. We have
Okay,
investment
who is the parent here?
Aflau.
Okay.
Flow is a parent.
So what do we have to do? Okay, the question will
first
prepare the statement of profit or loss for the Aflao group. So you have this one, you have the group over here, then you have consolidated
Statement of
consolidated statement of profit or loss, and other comprehensive income. Please, they will give you ticks for this one, other comprehensive income. So right there and get your ticks. The name of the company should come, other comprehensive income. For the year ended, you put the year there. Okay, so we are going to be having only one. So let's have revenue. The revenue of the parent is how much? Okay, 4,500. So we have 4,500. Okay, their cost of sales is what?
3,000.
3,000. Okay, then you have your gross profit. Okay, the gross profit, I say don't bring anything. Gross profit is calculated or is gotten when you subtract your cost of sales from revenue. Okay, then the next expense over there is what? The next item is what?
We have operating expenses.
Okay, this one,
456.
they have added all the expenses and name it operating expenses. So what are we having for the operating expenses?
456.
456. Okay, I'm saying that you can have some other income, but whatever be the case, bring share of associate profit. Okay, you might be having associates, so bring share of associate profit. If there's no associate, then fine, you can put dash over there and move on. Okay, so do you have any investment income there?
Yes, sir. Investment
Okay.
income of 90.
Okay, that is for only the parents. So we have investment income of 90. So do you have finance cost?
No, sir. We have a tax charge.
We don't have any finance cost.
No finance cost.
Okay, let's bring an item for finance cost. Maybe we might encounter some there. So, or maybe they have included that one. So let's put a figure there. Let's have the share of associate profits. If at the end of the day you don't have anything relating to them, then you just put that there and move on. Share of associate profits. Okay, let's go to the tax charge.
Tax charge / relief is 120.
Is it positive for those people or negative?
Negative.
Okay, so we can have 120 here. Okay, then we have profits after.
Profit for the period is 169.
Okay, that one we don't do anything about it. Profit for the period, which is the same as profit after tax. So you don't do anything for that. Okay, so you can leave a space and we can go and show our group structure here. Okay, the group structure is necessary. Okay, so let's have our group structure. One, we'll be reading and bring the group structure here. Please, there's no format for the group structure, but I would advise you to put it in a what? In a table. So you can have the table over here. Then you have the name of the company. So I'll have two because we have an associate. I can have 3 columns over here. So I'll have something here like this. Okay, so let's do that now. Okay, this one, unless the question is asking us for good job, that what we can show now is the what? Is the what we can show now is the group structure for now. Okay, but we have to be reading to identify who the parent and who whatever. Okay, just pick the footnote one for us now. All right, just pick the footnote for us now. Additional.
Okay, so additional information A. On 1st July 2012, Aflao invested in 30% equity interest in Denu for 510 million Ghana cedis and has exerted significant influence over Denu since that date. Denu's equity share capital at current year end, which has not changed since acquisition, is 480 million. Denu's reserve balances at acquisition were 600 million, including other reserves of 120 million.
Okay, let's stop there. Okay, this one, for this particular one, this person is an associate. We don't have control. So we are not the owner of that particular company. So we can't add their operations to our own. Okay. But what we have to know is that they were acquired on what? 1st July 2012, isn't it? Okay. But we are doing this on 30th June 2015. So it means that we still have significant influence over them from the beginning of this year. So it means that we can have a full share of their profit. Is that correct?
Yes, sir.
Okay. So it means that we have a significant influence from these people from what? From 2012. So up to this year, it means that we still have that particular investment in them from the beginning of this year. So their profit over here, we are going to be having a full share of their profits. We are going to be having a full share of their profits. So we just come here and have share of associate profits. So that will be your percentage 0.3 multiplied by 246. Is that correct? Zero 0.3 multiplied by 246. Is that fine? Share of associate profit.
Yes.
So
Okay.
that's correct.
Okay, let's move
Yes,
on.
246.
That is correct, sir.
Okay, let's move on to B.
Okay,
Please, where
B.
did you get the 246 from?
That's the profit of the associate.
Okay. But it's okay.
May I continue?
Madam, can we move on?
Yes, please.
Okay.
Yes.
B. On 31st December 2014, Aflao acquired 45% equity interest in Viepe. On this date, Aflao and Viepe's remaining equity holders contractually agreed to allow Aflao to appoint and remove majority of the governing board members of Viepe, as well as to make unilateral decisions about Viepe's relevant activities. Viepe's equity share capital at current year end, which has not changed since acquisition, is 480 million Ghana cedis. Viepe's interim accounts for the first 6 months of the current year showed an after-tax loss of 84 million Ghana cedis.
Okay, I've said that under normal circumstances, more than 55% shareholding, more than 50% shareholding should give you ownership, isn't it?
Yes, sir.
But we have
Yes.
also said that there can be less than 50% and there will still be what?
Control.
Control. And whatever be the case, they will give you the reasons for you assuming that there is a control. And you can see that they have given you a reason here.
Yes.
Okay. Although what Aflao is having 45%, Aflao has the what? Has the right to remove and what? Appoint what? Key what? Or majority of the board members. You cannot remove somebody from a board member if you don't have control over that particular company. Okay. Your dad cannot ask you to go back to wherever if it doesn't have control over you. No, the only person that you can direct is the person that you have control over. So you say control is where you can direct how something should be done. That is control. So these people, they have the power to what? To remove and also appoint what? A majority of the board members. Okay. Another one also over here is that they should make unilateral decisions about their first relevant what activities. What do we mean by unilateral decisions? They'll make decisions on their own. So they'll just say this should be done and that will be done. Nobody is coming to what is coming to challenge what they are saying. So although they are having 45%, they are going to be having control. Although they are having 45%, they are going to be having control. Okay, we are not doing statement of financial position. So we only use those equity values at acquisition and other issues given to us over there when the question is asking us to calculate goodwill, or when we have some information about goodwill, or we have rate of what impairment on the goodwill, and we have to calculate the goodwill before you impair. So for now, we are going to be leaving that one now and move on to whatever is necessary for us. Okay. So this one, we are going to be leaving it for now and move on to what is important for us. Okay, just take the remaining issues. Let's move on.
Okay, sir. So I continue. The purchase and sale agreement relating to the Airpair's acquisition provides the following as consideration. First, transfer of Aplao's equipment having current value and fair value of 210 million and 246 million respectively at acquisition date.
Okay. So we will deal with that one if they are saying that has not been recognized. Okay. But whatever be the case, the asset will be transferred to them at what?
Your current value.
Hey. The
Their
asset will be
fair value. The fair value.
The fair value, fair value.
Why will you transfer asset at carrying value? Are you or you don't like money? If you are buying something right now from the person, okay, this particular transaction is having a commercial substance. So if you can, what you want to use to pay, if you can sell it in the market now for what? 246 million. You cannot give it to the person at 210. No, you give it to the person at 246. Or the meaning is that you sell it to somebody and use the money to buy whatever you want to buy. So the transfer will be done at what? At fair value of the asset. Or the company or the parent can decide to go and sell the asset to a third party and bring the money now to what? To give it to those people. If you're not going to take it at 246, we are going to be selling it and bring you the money. So it will be transferred at 246. Okay. If we are transferring at 246, what is happening here? The carrying value is 210 and we are transferring at 246. What is happening there?
The fair value gain.
Gain of 66.
There's a gain of
Gain.
Yes.
There's a gain of 36, isn't it?
36, yes.
Okay. We will deal with that one if they are saying that these things has not been recognized. So we deal with that one. If they are saying that this thing has not been recognized. So just move on to the next one. Let's see.
Next one.
Yeah.
Issuance of 120 million equity shares of Aflao on 28th February 2015, 2 months after acquisition. The share price of Aflao was 6 cedis each at acquisition date, 8 cedis at 28th February 2015, and 9 cedis at 30th June 2015.
Okay, please let me say this. Okay, this is the first time that you are going to be hearing it, and it's important that we learn new things every day. Please, the question will be saying that they are going to be issuing shares. Okay, they are going to be issuing shares, and they will tell you the shares will be issued at what? A date after the what? After the acquisition, and they will give you two different share prices. Please, you recognize the shares at the date that the what? The control has been achieved, or you use the share price at the date that control has been achieved. The meaning is that, okay, we have agreed that I'm going to be giving you today, I'm buying the company today, 45% today. So what will happen is I have to give you the money today. But what is happening is that you are telling me that, okay, you keep it. I will need the money at this particular date. So if you give me this money now, maybe I don't know what I'm going to use it for. So keep it. It's just like that is how we go about the share issues. So the share, when they say that the shares will be done, the shares will be issued at a particular or at a future date, please. You use the share price to value the shares at the time that control has been achieved. It means that is the day that you are giving them the shares. But they say that you should wait and give it to them at a later date. This is an equity. Once we recognize equity, we don't fair value. You cannot see equity or shares issued at 1 cedi and in the financial statement or entity, the entity will now say that they are bringing it to 2 cedis. No, we don't fair value what? We don't fair or we should not subsequently value what? Equity. So the day that the control has been achieved, please use the share price at that particular date. So if you are coming to value this one, we use the share price at acquisition date. So that will be the 6 multiplied by the shares that we are giving to them. So we are issuing them 120 shares. So the value will be 120 multiplied by 6. This is the amount that we have agreed on. But they are saying that we should give it to them after 2 months. Pay attention to this one. I know this is the first time. Use the share price at the date of acquisition or at the date that control has been achieved. This is financial reporting. Control will be achieved in just a single transaction. Use the share price at the date that the parent obtained control over the what? Over the subsidiary. So we are using the share price at acquisition date to value the shares that they are issuing to them. 120 multiplied by 6. 120 multiplied by 6. I hope we are cool with that one.
720.
Okay, so we'll be using that if they are saying something about that particular issue. Just can we move on to the next one?
Okay, next one. Aflao has not recorded the above transactions, but has charged professional fee of 12.6 million cedis in respect of this acquisition against its share capital.
Okay, so let's take the first one. Okay, the first one, we are transferring the asset we are transferring the land or the equipment at what? 246. But in our books it's 210, isn't it?
Yes, sir.
Yes, sir.
What is happening there? We have not recognized that. So if we are doing statement of what? Statement of financial position, we go and subtract the 210 from our PPE, and now what? Debit our investment with 246 and credit our group return earnings with what? 36. But we are doing
36.
statement of financial position over here. Come and add it to, you can add it to the investment income or other income. There's no problem. So you have, although it has not qualified to be investment income, but just add it to that particular one. They are all income. Are you okay? So bring the
Yes, sir.
36 over here as the income. Okay. The remaining, if you are doing statement of financial position, you remove the asset from your books, 210. The asset is carried at carrying value in your books, 210. Go and remove that. Okay. Go and remove that. The share issue, that will also be part of our purchase consideration. So if you are doing statement of financial position, you are going to be debiting your investments, which will be the purchase consideration. Then you credit your what? Your share capital. Your share capital will be increasing. You have shares and you are issuing new shares to what? Different shareholders. The shareholders will now be increasing. So your share capital will be increasing by 720. Some people, they think that the company is using existing shares to purchase. No, the existing shareholders will still be there, and you are issuing new shares. It's just like you are issuing new shares to outsiders for people to buy. Then you use the money to purchase the what? The subsidiary. So the shares will be increasing 720 to what? Statement of financial position. That will be share capital of the parents. You add the 720 there. Okay, but we are not doing statement of financial position. This will only be used for calculation of our goodwill. But we are here to see if we have to calculate goodwill or we don't have to calculate goodwill. Let's come to this one. They say they have charged professional fee for 12.6 million in respect of this acquisition against their share capital. If we talk about acquisition related costs, which of the costs should be capitalized? We have done this so many times. Which of the costs do we say should be capitalized? If you come to subsidiary parent relationship, which of the costs do we capitalize?
Cost of issuing shares.
Cost of issuing your own shares, isn't it?
Yes, sir.
But a professional fee, is it a cost that we are incurring to issue is it a transaction cost? Is it a cost that we are incurring to issue our own shares?
No, sir.
So what do? It should be expensed. All costs,
Yes,
all
sir.
acquisition related costs should be expensed.
Yeah, we were spent.
Except only cost of issuing your own shares.
Own shares.
All acquisition related costs should be expensed, except the cost of issuing your own shares. The cost of issuing your own shares is treated like what? Transaction cost under financial instruments, where you are going to be capitalizing it. So if you are doing statement of financial position, you will go and add the 12.6 million back to equity because they have taken it out. They have subtracted it. It has been charged against. This is an expense. Equity is what? Equity is just like a liability. It's having a credit balance. This is an expense. So if you are capitalizing, means you are going to be debiting. So they have subtracted this value from equity. You go and add it to the equity if you are doing statement of what? Of financial position. So you debit return earnings, which is the group return earnings. You subtract. Return earnings is a profit. Debiting means you are reducing. So you take the professional charges or fee to what? To group return earnings as an expense. Then you credit what? The equity, which is the equity of the parent. But we are not doing that. So we now expense this by bringing it to what we call the what? Operating expenses. You add it to operating expenses. So that will be 12.6 added to operating expenses. Okay. Let's be moving.
Okay. C. At the date of acquisition of the EP, carrying value of its net assets was equal to the fair value except two items. 1. The first relates to a contingent asset disclosed at 60 million Ghana cedis in VFS financial statements, which had an estimated fair value of 90 million Ghana cedis. At year end, this contingent asset is disclosed at 79 million Ghana cedis in VFS financial statements.
Okay, last time that we were talking about fair value adjustment, that is the intro to what? Intro to group accounts. We say that all assets and liabilities at acquisition date to be fair valued, isn't it?
Sir.
And I went ahead to say in exception of what? I've mentioned some items. The first one is head for sale, asset head for sale. I don't know whether you can remember that. I've said that asset head for sale at acquisition date, you have to use IFRS 5 to what? To measure it at acquisition date. And I also spoke about what? Contingent asset and contingent liabilities. Just, can you remember that?
I wasn't in class then, sir.
No, that is not an excuse. Okay. You don't know the footnote that you are going to be meeting there. The only way you can conquer is to prepare very well. If you are solving some questions and you are comfortable with them, if you go there and you don't meet those footnotes, you meet footnote like this, what are you going to be doing? Please, if you come to IS 37 provisions, do we recognize contingent assets?
No, sir.
No, sir.
The best that we can do is to what?
Is to disclose.
Is to disclose. Please take it from here. Contingent assets are never recognized. However, if it is a reimbursement, the person is telling you that if you pay this amount of money, I will give you the money back, or I'll reimburse you. Any expenditure that you incur, I'll reimburse you. So if you have incurred expenditure of 10 million, it means that the person is going to be paying you back. The person has given assurance. So you recognize what we call a refund asset. Apart from that, the best that we can do for contingent asset is to disclose. So please, we don't recognize contingent assets. However, contingent liability are recognized if the fair value can be estimated. So whether the question will not be telling you that whether it is probable to they are going to be paying, but if the parent can estimate the fair value of the contingent liability, we recognize that one. But for contingent asset, it's never recognized. So if you don't know, you put this particular figure, you use it. If they are asking for goodwill, it means that your goodwill is going to be wrong, your total net asset is going to be wrong, and a lot of issues are going to be wrong. And if you are not sure of an item that you are treating, okay, you are not sure of the treatment, please don't go ahead to add. Okay, you are passing an adjustment for a particular entry that you are not sure. Please don't attempt to add, because you will end up adding for nothing. As mean you are sending a figure to return earnings, group return earnings. You don't know where to send it. You say, well, let me send it to group return earnings. You are not sure. And since you are not sure, the possibility that the thing is wrong is very high. And you have taken your time to add the return earnings figure one by one and send it to statement of financial position for 0 ticks. The addition that you have done, 0. You have wasted your time to get nothing. So if you are not sure, please don't even bother to add. If you are not sure of the figure that you are adding there, if you are not sure that if you add it, or you are not sure of the treatment, please save your time and move on. So contingent asset is never recognized. If you see it under consolidation again, and they are saying that it is probable the entity is going to be paid, please, under IS 37, contingent asset is never recognized. We only disclose. So please ignore this one and move on. Let's come to the second item.
The second item.
Sorry. So which one do we recognize?
Charles, can you help with that question?
We just disclosed that.
So no, I mean contingent assets, we only disclose it. So which one
Yes,
do
sir.
we recognize in the net assets?
Relating to what? Relating to assets?
Yes.
So anything relating to contingent assets, you disclose, you don't recognize. So like I said, this particular statement, the best we can do to it is to disclose it, but then you can't add it to either our net asset or whatever asset it may be. You just have to show that this thing happened, as in by way of sorry, by way of disclosing it.
Thank you.
But now we don't have a type of contingent asset. Anything that is going to be based, any payment that you are going to be receiving, which is based on something that is going to happen. Okay, it is based on
Okay.
something that is going to happen, which is outside your control. It is called contingent asset. So if you are going to be receiving money from me and the money is going to be based on something that is going to be happening, it is contingent asset. So we don't have types of contingent assets. Anything that is going to, any amount that you are going to be receiving, that is dependent on a condition or something that is going to happen, which is outside your control. It is termed as contingent asset. Okay, and we never have contingent asset. Okay.
Thank you.
All right.
Okay, so the second relates to land property with its carrying value below by 60 million. The recoverable amount of the property at 30th June 2015 was measured at 360 million. Aflao Group accounts for all items of property, plant, and equipment at cost.
Okay. So at the date of acquisition, they are saying that second relates to land property with a carrying value below fair market value of what? 300 by 60 million. Someone should decode this thing for us.
So this is a fair value gain. That is, the carrying amount of the PPE is lesser than the fair value. I mean, the fair value is higher than the carrying amount of the PPE in their books.
Okay. So the fair value is higher than the carrying value by how much?
60 million.
60 million.
60 million.
By 60 million. Please, the English is very important. Okay. The second relates to land property with a carrying value below fair market value of 300. The fair market value now is 300. Okay. And the carrying value is below the fair market value of 300 by what? By 60. What it means is that the carrying value in the books of the entity is 240. Then fair value now is what? Is 300. This is land. This is not going to be bringing any additional depreciation, isn't it? If
Yes,
it
sir.
be a depreciable item, then we charge depreciation. Because if we are incorporating this at the beginning of the year, it means that we are going to be using it for some particular period. The 60 will be recognized at the date of acquisition, which is 31 December. So from 31 December to the reporting date, if it's a depreciable asset, it means that we have used some part of it. If it's a depreciable asset, we have used some part of it, and we have to calculate depreciation on that. But this is not a depreciable item. This is not a depreciable item. So we treat that when we are doing what? If it should be statement of financial position, we just go ahead and be doing this under the net asset. But this is statement of what? Profit or loss. So unless they are asking us to do goodwill, that is why we are going to be using these ones for now. So we are going to be leaving this and be moving on and be tackling the issues that will be taken to what? That will be taken to profit or loss. Charles, the D.
D.
Okay, let's come
Aflao
here. Is there any impairment on this one? They say the recoverable amount of the property at 30th June 2015 was measured at 360. What will be the carrying value of the land property at the end of the year? That will be 300 million, isn't it?
Yes.
Yes, sir.
Okay, and the recoverable amount is what? 360. No impairment, isn't it?
Yes. No impact.
Okay. So let's move on to the D first.
D. Aflao transferred raw materials at their cost of 60 million to Viepe in March 2015. Viepe processed all these materials, incurring conversion cost of 30 million Ghana cedis, and dispatched them back to Aflao in May 2015 for 126 million Ghana cedis. At 30th June 2015, Aflao had sold 84 million Ghana cedis bracket at transfer price to Viepe of these goods to its outside customers for 120 million Ghana cedis.
Okay, this is intra-group what?
Trading.
Okay, so I will show you how you should go about this one. You can assume that this is going to be two intra-group trading. Okay, you can see that the parent is the one transferring the raw material. Okay, if the parent is transferring the raw material, we consider the parent is selling to what? Someone can say that the parent is transferring, so it's when the parent is selling. But this is going to be, there's no profit element on this one, isn't it?
Yes, sir.
Yeah.
They are transferring at cost, no profit element. But if the parent is recognizing this, the parent will recognize this in their books as sell, and Apply will also have this as what? As purchases, isn't it? Okay.
Yes,
So
sir.
first of all, we can remove the first transfer. Then we now come and focus on the what? On the sell itself. So in their separate financial statement, the time that this particular material has been transferred, the time that it has been transferred to what? To Apply, the parent is going to be having it in their books as what? As a transfer, which is going to be literally be recognized as revenue. And the subsidiary will also receive this as what? As cost of sales now. Okay. The subsidiary will receive this as cost of sales now. Then the subsidiary will give it back to what? To the parent. And the parent will now recognize it as what? As cost of sales now too. And the subsidiary will also have this as what? As cost of sales. As revenue rather. The subsidiary will have this as revenue. So I'm going to be telling you can decide to ignore the 60 because there's no profit element on it. 60-60. There's no profit element on it. But let's come here. Okay, let's come here. Since we cannot have sell within the group, that means that the 60 transfer also, you should remove it and focus on the sell itself. But you can decide to ignore because there's no profit element on that one. Okay, but let's come to this issue. Okay, the time that the parent is transferring this, the parent will recognize that as what? As revenue, which is 60. The Apply will recognize that as what? As purchases. So they will have that as purchases as part of their cost of sales. That is still the same as 60-60. No profit element. So you can see that it will cancel. Literally, it will cancel. Okay. Then these people, they will now process this thing now. So if they process now, if they process this particular item, they will incur a cost on it. Okay. So the cost that they incur, they will now treat. So they have incurred what? They have incurred
30 million
30 million conversion cost. So they will now treat this one. They will now say they have a cost of the inventory of 90 because they received it from the parent at 60. They have incurred a cost of 90. This will be in their cost of sales. The parent will also receive the item now at 126. Okay, but we only focus on the sale. We are only interested in the profit that is here to be recognized, and that has been what? That is included in the statement. So what we do over here is you can remove the first 60-60. Okay, that is a transfer that will be recognized in their books, but that is not the actual sale. So you remove 60 million over here, then you remove the 60 million over here. Okay, then that is the transfer. Okay, that is a transfer. The meaning is that we are just buying the goods for what? We are just buying the goods for Japan. We are just buying the goods for them. We are not selling to them. They don't have money, so we are buying the goods for them. That should be the situation. Okay. Then we now come to the issue itself now. These goods has been what? Has been processed and they have incurred a conversion cost of what? 30. It means that the total cost of the item to Japan now is 90. They have now transferred these particular goods back to Apply in May 2015 for how much?
126.
Okay.
126.
So it means that they are selling the goods. If they are also transferring without what? Without selling, then it means that the transfer should be at 90, isn't it? If there's no
Yes, sir.
profit,
90.
it will be at 90. So you can see that 90 against 126. What is the difference there?
36.
36.
Okay. So it means that they have added a profit of what? 36 to that particular item, isn't it?
Yes, sir.
Yes, sir.
So what we have to do first is that we cannot sell within the group. So what we do is we remove the sell first. So in the revenue of VFR, they are having 126 as revenue. In the cost of sales of the parent also, they are recognizing that the goods that they receive, they will recognize it as purchases. Okay, so they supposed not to what? They supposed not to recognize that as what? As cost of sales or as revenue. Okay, so what we do over here is where all the goods sold,
No,
where all the goods sold.
no, sir.
No, sir.
Okay, what is the quantity of the goods sold?
84 million.
84 million. What will be the portion that will be left?
42.
42. 42 million.
Okay.
Yes, sir.
The profit element on the item is 36, isn't it?
Yes, sir.
Yes, sir.
Okay. This particular 36 is equivalent to items worth 126, isn't it? If we are able to
Yes,
sell
sir.
all the 126, then we make a profit of 36. Is that the case?
Yes, sir.
Okay. Now, we were able to sell only 84. It means that we recognize profit relating to the 84, but we were not able to sell 42. So if 36 is 126, how much will be 42? Because if you sell all the 126, you have a profit of 36. This over here is the selling price. This is also the selling price. So there's no issue of margin or markup here. But if you like, you can calculate your own margin or markup and apply it. Okay, I will show you how to go about that one. But the simplest way to do about this is that the selling price is 126. If you're able to sell all of this, you make a profit of 36. You were not able to sell 42. What is the profit element relating to that? Ratio and proportion. That would be 42 over what? 126
times
There you have
36.
it.
12.
So it's
Okay.
That's 12.
So the provision for unrealized profit, let's come here. Provision for, so let me have provision for unrealized profit over here. Please, we have taken our time to explain this one. So you can use our YouTube channel, which is Assurance Professional School. You search for Intro to Group Account or Intra-Group Trading. Okay. So you see this one over here and you appreciate it. So that will give us 12 million, isn't it?
Yes, sir.
yes, sir. 12.
Okay. So it means that we come and add the 12 million over here to the cost of sales. But if you are doing statement of financial position, what will be the corresponding entry?
The net asset schedule.
We add it to our inventory.
Hey,
No, net,
Group return earnings.
Group retained earnings.
no,
It's already the
it's not
net
the
asset
parent that
schedule.
is selling, it's the
It's the
subsidiary that is selling.
subsidiary.
Net
Yeah.
assets acquired.
So at reporting, we take it away from it, isn't it?
Yeah.
Exactly.
Inventory should be measured at lower of cost and what?
And net
Net
realizable
value.
value.
The parent is valuing the inventory at our selling price. They will have 42 in their statement of financial position. So you go and take the 12 from it. So
Yeah.
the entry will be debit the net assets as reporting, credit what inventory. Are we okay?
Yeah.
Okay.
Yes, sir.
I'm saying that you can also calculate your margin like this. Okay. So you can calculate your margin and apply it. You know that 36 is the profit. 36 out of 126. Okay. What is your percentage?
29%.
20. Are you getting
Nine.
Desma? No, don't
It's
do that.
28.57.
Okay. Multiply it by the total figure. What are you having? Don't do approximation.
That's
So
36 or 35.99.
no. 36 over 126 multiplied by the value of the goods that are yet to be sold.
It's 12.
It's 12, isn't it?
Oh, okay.
Yeah.
So you can do whatever you want to do. But the easiest way is to use ratio and proportion. That is, we remove that particular one now and run. Okay. Just take the please forget about the Aplau has sold 84 million of these goods to its outside customers for 120. Aplau might incur what other costs or some other costs that they want to recover. We are not interested in how much Aplau is selling the goods. We are only interested in the profit that the seller is charging. What is the portion of the profit? The profit was charged on the goods that have been given. So we are only interested in the profit element that the subsidiary is having in its financial statements. So we don't care about how much Aplau is selling it. We don't care about that one. We are only interested in what is the profit relating to the item that the subsidiary has transferred to the parent. That is here to be what? That is here to be recognized. That is what we do. All right. Let's come to the E. Just can we take the E now?
E.
Oh.
So E. On 1st April 2015, Viepe and Denu bought 10 million and 5 million equity shares of Buizla, respectively at price of 12 million plus 1% transaction cost. Both Viepe and Denu elected to account for the investment as financial assets held through other comprehensive income. These investments have not been updated at current year end. Fair prices of each Twizzlers equity share at year-end was 10.8. Total number of Twizzlers equity shares is 100 million. Both entities had not earned any other comprehensive income prior to 1st April 2015 within the current year.
Okay, so let's come here. They are saying that on 1st April 2015, that is the beginning of the year, isn't it?
Yes, sir.
Okay, so the beginning of the year, what happened? Jeffrey and Denu bought what? 10 million. That is the associate and the subsidiary, isn't it?
Yes, sir.
Okay, bought 10 million and 5 million equity shares of what? Of this
Both,
particular,
sir.
okay, respectively at a price of 12 million, plus what? 1% transaction cost. Okay, both Jeffrey and Denu elected to account for the investment as financial asset held through other comprehensive income. So this is a financial asset. The financial asset is through equity instrument. So financial asset through equity instrument, we use only two classifications, either profit or loss or other comprehensive income. And they are now accounting for this one through what?
OCR.
Through OCR, isn't it?
Yes,
All right.
sir.
So let's look at the value of their respective investments at the time that they are acquiring these people and see what we are going to be having there. So let's have for VFA, what is a financial asset? What is the value of their financial asset at the date of what? Okay, so their financial assets, their financial asset, their financial asset is going to be what?
10 million and 5 million.
Okay, 10 multiplied by
10
12.
million.
So
No,
10 times 12.
120.
10 times 12.
120 million.
Okay, so their financial asset, let me do this one very well. So their financial assets, so let me have financial asset over here for VFA, their financial assets. Okay, VFA, we have the nominal value or the purchase price. Okay, the purchase price will be
10 times 12.
10 multiplied by 12. That will give us 120, isn't it?
Yes, sir.
Yes.
They say transaction cost is what?
1%.
1%.
Okay, so the financial asset classified through other comprehensive income, their transaction costs are capitalized. What do we have? 1% on this one.
1.2.
Okay, 1.01 multiplied by 120. What are we having? 1.2.
1.2.
Okay, total will give us 13 point what?
13.
1 to
1
1.2.
to 1.2.
Okay, 1 to 1.2. Let's come to that of what? Then what will be their financial asset? That will be the
5
purchase
times
price. The purchase price will be
5 times 12.
5 multiplied by
12.
12. And how much are we having?
60.
Okay, and their transaction cost will also be 1% of that amount. So 0.01 multiplied by
0.6.
okay. So that will give us 60.6, isn't it?
Yeah.
Okay. Okay. So this is carried through other comprehensive income. At the end of every year, we fair value. So at the end of the year, we have to fair value. Let's come to what they are saying about the fair value adjustment over here. So the fair value, okay, the fair value adjustment. They are saying that this investment has not been updated at the current year end. Fair price of what? The entity share at year end was what? 10.8. 10.8. So what do we do now? It means that at the end of the year, we now have what? The fair value at the end of the year. Okay, the fair value at the end of the year will be 10 multiplied by what? 10.8, isn't it?
10.8.
Okay, what are we
Yeah.
having?
108.
108.
8.
Okay, so that will give us 108. Okay, so this particular 108, what is the difference between the figure there, 108 against what?
18.2.
Now the fair value loss is what?
18.2.
Okay, 18 point what?
2.
18.2. Okay,
18. 1 3.
okay, 13. So we have 13.2. Okay, we'll come to these people also. Their fair value will now be, so their loss, the fair value. So let's come here. We have the loss over here. We have the loss over here. We've been bringing the loss there, but the fair value, let's have the fair value there. So we have the fair value at the end of the year will be what? Will be 5 multiplied by 10.8. What are they having?
54.
50.
4.
Okay. So what will be the fair value loss?
6.6.
6 points.
6.
Okay. So we have 6.6. Okay. When was the subsidiary acquired? When was the subsidiary acquired? Can we go back to?
December.
31st December.
Okay. Subsidiary was acquired on 31st December. Okay. When are we reporting now?
3rd June.
30th June. So 31st December 2014 to 30th June. How many months is that?
6 months.
6.
Okay. So we have to consolidate the subsidiary even first before we come and do whatever we want to do. So we come here, we have plus what? 6 over 12 multiplied by, what is their revenue?
2880.
28.
80.
Okay. Their cost of sales is what?
2544.
2544.
40.
Okay. Their operating expenses?
408.
408.
8.
Okay. They don't have any investment income.
Yeah.
Okay. No finance cost. Their tax charge is what?
They had a tax relief. 36.
Tax relief is 36, isn't it?
Yes.
Okay, so that will be 6 over 12. This will be a subtraction, isn't it?
Yeah, minus.
Yes.
Okay, so minus 6 over 12 multiplied by 36. Okay, so let's come to, we now have some issues about other comprehensive income. Okay, we have some issue about other comprehensive income now. So the other comprehensive income, we have the share of what? Associate what? Fair value loss. So the associate loss on that was 6.6, isn't it? The loss on the financial asset of the associate is 6.6, isn't it?
Yes.
Okay.
Yes.
And that one we are having a full year influence. So we have 0.3 multiplied by 6.6. What about the share of the subsidiary? The share of the subsidiary will be what? 6 over 12 multiplied by what? 13.8, isn't it?
Yeah.
The investment was purchased before acquisition, so the loss will be assumed to accrue evenly throughout the what? Throughout the year. Okay, so we have the 13.8, we have 6 over 12 multiplied by 13.2. Okay, so we'll be having that figure now, and we can move on to the next issue now. Okay, let's come to okay, so let's come to what issue. So we are done with that now.
Sir,
Yes, please.
please, the financial assets, it
Yeah.
was on 1st April 2015, and that was before the after the acquisition.
Okay. 1st April is the what?
That is after acquisition, post-acquisition period.
Are you sure?
Yes, we are
Oh,
consolidating on 30th June 2015.
okay. Sorry. So that loss will be purely for what? For post
It's
acquisition.
post-acquisition.
Okay.
Yes, please.
Sorry. I was thinking it's actually 2014. So this will come here. The parents, this will just be 13.2. Okay. This is purely what? Purely after acquisition. Thank you. All right. But for the associate, it's going to be 0.3 multiplied by their loss, isn't it?
Yes, please.
Okay. Thank you. Thank you very much. So I was thinking it was first, maybe the start of the year. Okay. Thank you very much for that. Let's come to this one. Just take the F for us. Charles, are you there? Hey.
Okay,
No.
F.
All right.
Both Aflao and Denu have correctly accounted for Denu's dividend in their separate financial statements. Aflao has included its share in investment income.
Okay. So what are they saying there? They are saying that Denu is a subsidiary, isn't it? Okay. So both Aflao and Denu have correctly accounted for Denu's dividends in their separate financial statement. Aflao has included each share in investment income. Let's count to the dividend. Count to the H. Count to the H there. If you count to the H over there, what is the dividend paid by what? Paid by the associate is the third one. The associate figure is the third figure. So what is the dividend paid by them?
60.
60. Okay. The parent is going to be having what? What share of it? The percentage share.
30%.
Okay, 30% of that will be what?
Just
18.
18, isn't it?
18.
Okay. The dividend is paid out of what?
Retain earnings.
No.
Profit.
Profits for the year.
Okay. The dividend is paid out of the profit for the year. Okay. Dividend is paid out of the profit for the year. But what are we doing over here? We are having the share. Please, someone's listening is giving. Please, if you're not talking, just put your mic off. Okay. But what are we doing? What are we doing over here? We are having a share of the associate profit, the total profit, which is the profit before dividend. So it means that the dividend is included over here. The dividend is included over here. So the dividend of 60 was paid out of the 246. Now we are having the share of the 246. It means that we are having the share of the profit including the dividend. So you cannot have the dividend again. So you come here and take your 18 for the investment income because the 18 is what? Is in the 246. It is out of the 246 that we have paid the dividends. Okay, so we are having the share of the what? Of the total profit, which is including the dividends. So you cannot have the 18 again. If you're having the 18, it means that you are telling us that, okay, they have made a profit and you have 18 and you are still having 30% of the different profits. No, the dividend is paid out of the profit. The dividend is paid out of the profit. So since you are having a share of the total profit, it means that you are having the share of the non-cash profit and also the cash profit, which is a dividend inclusive, which are all included in the 246. After they declare 246, they will pay dividends of 60. But you are having a share of 246. It means that the dividend is included already. So what we do is we come and what? Take the dividend because the dividend is already included in the profit. So you subtract the 18 from the investment income because the question is saying that the parent has included a share in the what? In the investment what? Income. Let's take the G now.
Right. G. Aflawor's policy is to credit any bargaining gain on purchase of subsidiaries to operating expenses. No impairment charges have been made against investments in Denu in previous years. At current year end, an impairment review carried out on investments in Denu showed that its recoverable amount was 620.4 million.
Okay, so we have to now calculate whether at acquisition is a good year or it's not a good year. So they are saying that the policy is to what? Is to account for any bargain on purchase of subsidiary to operating expenses. So we are going to determine whether it was a good year or it was a gain on bargain purchase. So we now have to calculate our good year now to know what is happening there. So let's come to our good year calculation now. So we have good year calculation. Okay, let's come to good year calculation. So we have our purchase consideration. Okay, our purchase consideration consists of two issues, isn't it? We have the transfer of land, and the value was 246. Okay, then we have issue of shares, which is share exchange, or issue of shares. The issue of shares was 120 multiplied by 6. That was 720. The total value is what?
966.
Okay, so we have
966.
Okay, let's come to the net asset at acquisition. So we come and calculate the net asset at acquisition now. Okay, so we have their share capital. What is their share capital? So the question has given us their share capital from the start. We go and look for the share capital there. We go and look for their share capital over there. What is the share capital? Okay, so let's come here. The equity share capital at current year end, which has not changed since acquisition, is 480.
It's 480.
Even if they haven't said anything about place, what we do is that there will not be any new issue of shares, because we want the parents will have the same percentage holding. So if you are issuing new shares, it is going to be changing the percentage holding. So we have 480. Okay, so we now have 480 as a share capital. Do they have any? So let's check whether they have. So we look at the retained earnings. Please pay attention to how we are going to be calculating their retained earnings now. Okay, let's come here. Okay, do they have any other component of equity?
It was not.
They don't have any other component of equity, isn't it?
Yeah.
Okay, so let's come to this particular one now. Okay, let's come here. All right, so the first interim account for the first 6 months of the current year show after tax loss of what? 84 billion. We acquired them on 31 what? December. So they are just saying that from the start of the year to the date of acquisition, they have made a loss of 84 million. Okay,
Yes.
but let's go to their statement now. What figure are they having over here?
36.
They have a loss of 36, isn't it?
Yes.
Okay, how come? Let's come here. They have 84. For the first 6 months, they have 84, isn't it?
Yes.
Yes.
For the first 6 months, they have 84 as a loss. Now they're having 36 as a loss. It means that during the last 6 months, they made a profit of what?
48.
48. Okay, so let's come here. We are going to be calculating this very simple. Okay, let's calculate this very simple and move on. Okay, let's come here. So let's come to what is their retained earnings at reporting?
1524.
Oh, they have other reserves. Okay, they have other reserves. They have other
Yes,
reserves.
204.
So they have other reserves at the end of 2014, isn't it?
Yes.
Okay, look at this question. They are saying that both entities have not earned any other comprehensive income prior to this one. prior to this one. So it means that this other comprehensive income will still be the same figure at what? At acquisition. Because there was no what? There was no other reserve that was earned prior to what? First April. There was no movement in other reserves prior to this particular year, which is the April 2015. There was no what? There was no other reserves. So this particular one was other reserve at the beginning of what? At the beginning of this year, which is 30th or 1st July 2014. And we have acquired them at what? 31 December 2014. And they are saying that there was no other reserves prior to this particular year. Both entities have not earned any other comprehensive income prior to what? 1st April 2015 within the current year. So it means that from the beginning of the year up to now, there is no movement in other reserves. So these other reserves is relating to previous years before the acquisition. So we have the other reserves to be 204 in that particular figure over there. So we have other reserves. So let me have other reserves to be 204. Okay, let's come to the retained earnings now. It's very simple. Okay, pay attention to this one. Let's move on. What is the retained earnings at reporting?
36.
No, the retained earnings. Look at the figure, the table that we have.
And 1524.
Okay, how was this particular retained earnings calculated? The reporting figure. It was the opening figure plus the profit for the year, isn't it?
Yes.
Okay. So we can say that the retained earnings will be the retained earnings at the beginning of the year plus what? The profit for the year. That will give us 1524, isn't it?
Yes, sir.
Okay. So we can say that we don't know the opening. Do we know the opening? We don't know the opening retained earnings. Okay, but we know that they have subtracted the profit, which is a loss. It was a loss. So we have taken the 36, which is a loss for the year, 36, from the opening retained earnings figure, and we have now gotten what? 1524. Okay. So the retained earnings will be this figure plus what?
That's 36.
Okay. What are we going to be getting?
1560.
1560, isn't it?
60.
Okay. This is the opening retained earnings figure. When was the acquisition done? 6 months after, isn't it?
Yes.
So it means that for us to get the retained earnings at acquisition, we need to add 6 months profit to this, isn't it?
Yes.
And that 6 months is a loss. So we take what? 84 from this one.
Around 476.
Are we okay with the 84 that we are taking? From the start of
Yes,
the year is 1560. We acquired them after 6 months. What it means is that we have to add 6 months to what? We have to add 6 months to the retained earnings at the beginning. Because the beginning is 1st July 2014. We acquired them on 31 December 2014. It means that they have done 6 months already. So what will be their retained earnings at the date of acquisition? It will be the retained earnings at the beginning plus the profit from 1st July to 31 December. But the 1st July to 31 December, they are saying that they are making a loss. So it's supposed to be a loss against the opening figures. And that is how much?
There's noise at the background. Please, can you mute it? Oh, go get.
Hello.
Please, any noise, I'll just take you off. Okay.
Hello, sir.
Yes, please.
Please, wanted to know if the 36 is a trade loss or post loss.
Is what?
Is it a trade loss? Was it a loss before the acquisition, or is a loss after?
It's just a loss for the year. It's a total loss for the year.
Okay.
All
right. Thank you.
All right. Okay. So another way to do this one is that you know that you have to take. So let me just introduce this one in a different way. You know that you have to take 84 from what? 84 from the what? The figure at what? The opening figure, isn't it? We need to take 84 from the opening figure. Okay. But we have already taken what? 36. So how much will be taken in addition? So 15 to 4 minus what? How much do you have to take in addition? We need to take 84. We have taken 36 already. How much do we have to take in addition? I'm having 48.
48.
Okay. What are we having? You'll be having the same figure as if you do the 1560 minus what? 84. Okay. What are we having? 1524 minus 48. What are we having?
1476.
I'm sure it's the same as the figure that you have gotten first.
Yes.
Okay. So there was fair value adjustment relating to land, isn't it? There was a fair value adjustment relating to
Yes,
land.
yes.
Okay.
Yeah.
And that was
Yeah.
60. The fair value
Then
adjustment is
60.
Yeah,
Okay.
60.
So you have 60. Okay. So you
Then
now have
property.
the property is just a land property. Okay. That was 60. So what will be our
Yeah.
total? What will be our total figure here? Total net assets. 480 plus 1476 plus 204 plus 60.
2220.
2260, isn't it?
20.
Okay. But what are we having here? What are we having here? How are we measuring the NCI? Is it proportionate? The question will tell us something
Yes, yes,
about.
yes.
Let's look at the NCI. Is it proportionate? Apply measure non-controlling
It's
interest and the
proportionate.
proportionate of the. So what
Very
is
identifiable.
that? We are going to be looking at the net asset of the parent, isn't it?
Yes.
So this is a total net asset. So the one that we are going to be doing for the parent now will be 0.45. The total 0.45 multiplied by the total. Is that correct?
Yes, sir.
Okay. So the total multiplied by 0.45. What are we having?
999.
Okay. So 999. So we are paying 966 for 999. Is it a goodwill or is it a gain?
But again,
Again.
A gain of how much?
33.
Okay. So the gain of 33. So gain on bargain purchase. Gain on bargain purchase. They say this is charged to what?
Operating expenses.
Okay. So that is a gain. If you go to operating expenses, is it going to be addition or a subtraction?
subtraction.
Okay. So we come here and do minus 33. The expenses is what? Is a cost, and we are having a gain. So the income is going to be reducing the what? The cost. The income is going to be reducing the cost. Let's come to what they are also saying as the what? They are saying that the recoverable amount of the investment in Denu is what? 620.4. Okay. What we have to do is that we have to look for the what? We have to look for the fair value of the investment in Denu as at the end of the year. So we are going to be doing that now. It's going to be a very simple thing that we are going to be doing. Okay. Let's come here. What is the net asset of Denu at acquisition? What is the net asset of Denu at acquisition? So this is what we are going to be doing. So we do investment in associate here. Investment in associate. Investment in associate will give us the fair value. How much do we pay for them? How much was paid for the
510.
investment? That was 510. Okay. What is going to be increasing this is what? A share of profit and any other thing that will be coming there. Okay. So let's come to this particular situation here. Okay. So let's come here. Very simple exercise over here. Let's come here. What is the share capital of Denu? What is the share capital?
480.
480. Okay.
Yes, sir.
Their share capital is 480. Okay, let's go and establish that. Their share capital was 480, and their retained earnings and other reserve was how much?
600,
Okay,
including other reserves.
okay, what we are going to be looking at right now, is that what is the profit? What is the profit? What is the profit that we have? Or what was the profit made from the date of acquisition to up to date? Then we just find our share of that particular profit. Then we add it to our investment. That will give us the value of our investment as of today. So we calculate the profit. What is going to be increasing our investment from the date of acquisition to now is the profit. So the date of acquisition, let's calculate their net assets. Then we compare with what? The reporting net asset over here. So let's come here. Okay. So we have a net asset for them at acquisition. Okay, net asset for them at acquisition. So we have the net asset at acquisition. Okay, net asset at acquisition, we have their share capital. Share capital to be what? 480, isn't it?
Correct, sir.
Retained earnings to be what? Okay, let me just do it as a normal net asset table so that we can actually do at acquisition at. Okay, so we have net assets at reporting and at acquisition. So we have what we call the at acquisition for them and at reporting for them. Okay, so we have this figure in million, this figure in million. Okay, their share capital will be 480, the same figure at reporting also. Their retained earnings at acquisition will be 480. Do you agree?
Yes.
Sir.
Okay, it is 600 and 120 is what? Is out of that
Other
120
reserves.
other reserves. So we count to our other reserves also. Okay, other reserves will now be 120. Let's go to their retained earnings given to us over there. Okay, let's go to that down and see whether their retained earnings are actually closing figures. So you can see that retained earnings over here is a closing figure, isn't it?
Yes, sir.
Yes.
Which is 780. Okay, the retained earnings is 780. So we have 780 over here. Okay.
Other reserves is 190.
No, the other result, there is something that is going to be affecting the
Sorry,
other.
30th June
Okay.
2014.
So the 780 over here, which is a retained earnings, is including the profit for the year and also the dividend has been taken away already. Are we okay with that?
Yes, sir.
So we are only interested in the share of the profit. This is other reserve at what? 30th June 2014. They said that there were no other reserve again, but there was a loss on what?
Financial.
There was a loss on what? On a financial asset, isn't it?
Yes.
That loss, what would the loss be doing?
To reduce the reserves.
Okay, so what would be, so let me do it over here. Let me have the other result that they have over here, which is 192. And I'll bring the loss, the fair value loss. Okay, the fair value loss. What would be the fair value loss? That was 6.6, isn't it?
Yes.
Okay, so we have 6.6. Okay, so let's find the difference now. So at acquisition will give us 1080. Okay, at reporting will give us what?
One four four 5.4. 1445.4.
Okay. So what is the profit made from the date of acquisition up to now?
365.4. 365.4.
365.
365.
Okay. So what we do is that we find 30% of that.
365.4.
3. Is it the same figure?
The same figure,
Yeah.
sir.
Okay. So we find our share of that particular profit. That is the profit made from acquisition up to now. So our investment will increase by the profit. So 0.3 multiplied by 365.4. How much are we having?
109.62.
109.
0.62.
Okay. So what is the total?
619.62.
619.
0.62.
619.62.
Okay, 619 points what? 62.
62.
Okay. So
So no impairment.
there's no impairment, isn't it?
Yes.
Okay. So they say the recoverable amount is 620. Okay. So the recoverable amount is 620. Okay. Recoverable amount is 620. 620.4. Is there any impairment?
No, sir.
No.
Okay. Because you can say the carrying value is lower than the recoverable amount, isn't it?
Yes, sir.
Yes.
Okay. So this one, they just wasted your time, but they are going to be giving you ticks for that particular one. Okay. So what again? Is there anything that we have to do again?
Mm.
Okay. So you can add the figures now, but let me come to the share of the profit. Okay, let me just do the share of the profit, the share of or the profit attributable to you. So if you are doing statement of profit or loss, you now share the profit to them. So you are going to be having a total profit, but I'm only interested in what? In that of the subsidiary. So we have done that the last time. So we look at the NCL own. Okay. We know the profit that was made during the post-acquisition period was what? That was 48. Do you agree?
Yes.
The profit that was made during the post-acquisition was 48 million because they have 84 and they are having a profit for the year as 36. It means that during the year, they have made a profit of 48. That reduced the loss of 84 to 36. I hope that is clear now. Let's come to,
Yes, sir.
is there any adjustment relating to the subsidiary that was taken to profit or loss? There was an adjustment of unrealized profit. Do you remember the unrealized profit issue?
Yes.
Yes,
Okay.
sir.
There were no issue of impairment on their goodwill. There were no other fair value adjustment, which will be leading to additional depreciation. The only thing that is going to be affecting this figure is the what? Is the provision for unrealized profits. So it means that 12 million is included here, which is here to be recognized. So we multiply by 0.55. If there's any issue of depreciation, what we do is just like how we do it under the net asset. So how do you determine the what? The profit. You take those post-acquisition adjustment to what? To net asset as reported. The same thing that we want to show over here. But the only thing that will be affecting the net asset of the subsidiary is the what? Is the provision for unrealized profit. So we do over here. Then if you come here, what answer are you getting? What is the answer that you are getting?
19.8.
Okay, 19.8. So the total profit that you have made, the total profit that you have calculated, you subtract the 19.8. That will give you the parent own. Then you also come to the share of what? Share of the other comprehensive income. This one, the subsidiary is going to be having 55% of the loss on the what? On the financial assets. Okay. So you after this one, you stop over here. You will come to the share. Oh, there's no space there. But let me show the share over here. So you come to the other comprehensive income attributable to the parents. and the same time the NCI. And the other comprehensive income is actually what? Other comprehensive income, or we can say total other comprehensive income you add. Then this will be giving you 19.8 minus 0.55 multiplied by 13.2. So this will be the share of the total comprehensive income for the year, because the total comprehensive income, the profit for the year is part of it. But this one, they are having a loss. So the loss is going to be reducing this figure. Then you have that particular one. I wish we can pick a question and put them together. Then we actually will demonstrate how to go about this one. Okay, it's a very simple question, but somehow technical. Okay, you have to be very mindful in your thoughts to be able to. But if in case they want to give you this question, the footnote cannot be plenty like this. Okay, they will reduce it because of the time issue. Okay, let's come to the question number 3, and we pick a ratio question. Yeah.
Okay, so question number 3. On 1st October 2013, Hayden, a publicly listed
Who is the
company.
parent? Who is the parent? Fast.
Hayden.
Okay, what is the
Hayden.
requirement? Let's look at the
Hayden.
requirements. What is the requirement? So we are doing profit or loss and financial position, isn't it?
Yes, sir.
Okay, so let's not waste time. Let's move on. Let's put our structure there. So we have the Hayden group consolidated what? Consolidated statement of profit or loss. Please, there's a very interesting issue over here, which you have to pay attention to. Okay, so statement of profit or loss for the year ended. We have revenue. What is their revenue? What is their cost of sales? Gross profit.
Hayden's revenue is 98,000.
98,000. Their cost of sales is what?
76,000.
76,000. So what is the next item after the gross profit?
Operating expenses of 11,800.
Operating expenses of 11,800.
800.
Okay. What again?
Interest income of 350.
Interest income of what?
350.
350. Okay.
Finance cost 420.
Finance cost of 420. So you can scan and through whether we have associate over there. Finance cost of what?
420.
420. So we can bring the share of associate profit over here if there's no associate. For profit or loss, when they are going to examine you on profit or loss, there will always be an issue of associate. The only issue that you are going to be doing about associate is the dividend and the share of the profit. So since you are having a share of the full profit, dividend is already passed. So you just reverse the dividend. That is the only thing that you are going to be doing when you are doing the share of the associate as part of this one. So what again? What is the next item? Profit before tax.
Yes, sir.
Okay.
10,130.
No, we don't add that one. Just don't go
Yeah.
and do that. That's a resulting figure.
Yes, sir.
So we have the tax expense, isn't it?
Yes, sir.
Tax expense and tax
Yeah.
relief. Or is expense?
Yes, sir. Tax
Yes.
expense / relief.
Okay.
It's negative, so
So these people, they are what? The tax expense for the parent is what?
4,200.
4,200. Is there any other comprehensive income there?
So profit for the year.
Okay. There is no other comprehensive income attached to the statement, isn't it? Okay. So
No.
we are doing two statements together. So you come to the same company, high downwards group. Okay. So if you are able to solve this one, it means that we have done the two together. So consolidated what? Statement of what? Financial position. Financial position as at. Okay. So we have this figure. We have their assets. Okay, then we have their non-current assets. So the non-current asset, we have PP. Please, you can write PP, it's accepted. Are you okay? PP, NCI is accepted, but don't go and form some abbreviation for yourself. Some of them, they are something that is being used in everyday activities. So what is the value of your PPE?
34,400.
34,000.
Okay, 18,400. Sorry.
Okay, 18,400. Okay, so we have 18,400. 18,400. Okay, then we have investment. The investment you actually reconcile that one. Okay, the investment will be the amount that maybe the amount that they are paying for the shares in the subsidiary. So how much is there?
16,000.
16,000. So we go and reconcile this one. This will be cancelled this will be cancelled together with what? Together with the equity shares of these people. So we might have goodwill, we might have investment in associate. Leave a space. Come to current assets. Come to current asset. What are we having?
18,000.
Current asset, just one figure.
One figure.
Okay. That will give us 18,000. Okay, then we have equity and what?
And liabilities.
So equity and liabilities. So equity and liabilities, we have the share capital will be that of only the parents, because the subsidiary own will be cancelled with the parent investment and left with only goodwill. So what is the share capital of the parents?
10,000.
Okay, so 10,000. We have group retained earnings. We do workings for that. Do you have any other component of equity there?
A share premium of 5,000.
So we have share premium of 5,000. So that will give us, that is for the parent. So there's no other issue. We have NCI, isn't it?
Yes, sir.
So our liabilities, what do we have for the liabilities?
7% bank loan.
Is it non-current or current, or just the liabilities?
Non-current.
Okay. So we have non-current, and we have 7% what?
Bank loan.
7% bank loan. 7% bank loan.
6,000.
6,000 for the parents. Okay.
Yes,
What
sir.
again?
We have 10% loan from Haida.
Okay.
That's for the subsidiary.
10% loan notes from. So we'll be looking at that letter. Okay. What again? Current liabilities.
Yeah, current liabilities. Just one.
Okay. So we have current liabilities to be how much? Current liabilities.
11,400.
11,400. 11,400. Okay. So we can actually do our workings over here. Since we are doing statement of financial position, it means that we have to do our net assets, group structure, and all those issues. So we have our group structure. Okay. So let me show the first group structure. Okay. So the table that I have over there, let me come and show it. So this one, I will have the name of the companies here. So I'll have Jeppe over here. Then I'll have Denu, because I say you should do it in the what? This one. Then you have a parent. Parent will be having 45% over here. Then we are going to be having 30 over here, isn't it? Okay. So
Yes.
NCA over here will be what? 55%, isn't it?
Yes, sir.
So you put
And
you have your date of acquisition. Okay. So you have the date of acquisition here. The date of acquisition for each of them. This was July 1, 2012. Oh no, this was 31 December. So this was December 2015, 2014, okay.
2014.
And this was July what? You write a date in full, 2012. Okay, reporting date is what? Reporting date is June
30th June 2015.
2015. The same reporting date for this one too. So 30th June 2015. Then a post-acquisition period. You bring the post-acquisition period here. Okay. So post-acquisition period for this one is 6 months. For this one will be like, let's say 3 years. That will be like 3 years.
3 years.
Okay. So you are done like this. Then you move on. Okay. You don't have to do anything. You can just, or you can have this one. You can decide not to bring the name over, bring their respective name. You can have subsidiary here. Okay. So you can have subsidiary here and you can have associate here. Instead of bringing their names, any of them, you are good to go. So we have this one, we are good to go. All right. So let's move on now to the group structure. We do the same thing in a table form. So we come to the net asset here. So the net assets, that will be for the subsidiary, which is whatever the name, we don't care. So at acquisition, then you have at reporting. So this one quickly you can go and do that particular one for them. You can go and do their reporting figure and also their acquisition figure. So 1,000 and 1,000. So their share capital, please, the share capital will be the same. So reporting figure will be the same as acquisition figure. What do we have?
2,000.
Okay, 2,000 and 2,000. Okay, let's go to, they might give you their retained earnings at acquisition, or we have to calculate that ourselves. But what is their retained earnings at reporting? That will be in the statement of financial position.
6,300.
63.
Okay,
300.
that is 6,300. We come and see whether the share premium over there. Okay, so 6,300. We come and determine whether the share premium over there is at acquisition or is at reporting. Okay, but the share premium at reporting, we have 500, isn't it? We'll be checking to see whether it is purely after acquisition or it is for reporting. But if nothing has been said about it, then it means that it will be at what? Acquisition. Why? Why do you think it will be at acquisition? I'm making a claim that if nothing has been said about it, it will be acquisition. Why will it be acquisition? Why do
Because
you
it
think?
means there's no change to it in the current year, so it's what brought down.
Okay, you have the idea, but I don't like the way you are saying it.
Because there was no additions or difference since it was bought.
Yeah, the voice is nice, but the way you are saying it, I don't like it.
So there was no issue of any additional shares. Share capital remained the same.
Just we need nice voice.
Oh, sir.
This is evening, so we have to be cool in the evening. Okay. Yes, what you have said is correct, because we said that there should not be any new issue of shares during the post-acquisition period, because we want the parent to maintain the same shareholding, isn't it? When do we
Yes,
have
sir.
share premium? It is when we issue the shares above the share price, isn't it?
Yes, sir.
So if you are treating this as what? As a post-acquisition figure, it means that you are telling us that there have been new issue of shares. Okay, there have been new issue of shares. So that is not the issue. So if nothing has been said about it, and nothing will not be said about it, so it will be treated as what? Both at acquisition and also at what? At reporting. Are we okay with that?
Yes,
Okay.
sir.
So if nothing should be said about it, because there should not be any new issue of shares. We want the parent to maintain the same shareholding. Okay. So we'll be reading the top now to know, so we can open the bracket down. Okay. There are certain things that we have to do. So we have to also calculate goodwill. So we can have workings 3 over here. The third workings to be goodwill calculation. So we can have goodwill calculation. Okay. Goodwill calculation. So that will be in 1,000. So we bring the purchase consideration over here. We come and take care of that later. So what do we have over here? Then we have the NCI. So we have our goodwill calculation. The space is too much for that. So we have our NCI. So we come and do our weekends for the NCI. We now have our group return earners. Group return earners. They don't have any other results or revaluation issues. So we can stop here now and be moving. We can stop here now and be moving. So just read the top there, then we take them one by one.
Okay, so the following information is relevant. I, at the date of acquisition, the fair values of Systan's property.
No, the top.
Oh, okay. So on 1st October 2013, Haidan, a publicly listed company, acquired a 60% controlling interest in Systan, paying 9 cedis per share in cash. Prior to the acquisition, Haidan had been
Okay,
experiencing
let's
difficulties.
determine the purchase acquisition. Let's determine how much they are paying. So they have acquired 60%. Okay.
Yes, sir.
They have acquired 60%. If they have acquired 60%, how many shares were there before they are acquiring 60%?
That's 2,000 divided by 1 cedi. So
Okay, that would be
2,000.
2,000. So how many shares are they buying now? How many shares are they buying?
60% of
The 2,000. That will give us how much?
1,200.
Okay, multiplied by. So our purchase consideration will be 1,200 multiplied by 9. How much are we getting?
10,800.
10,000.
800.
Okay, so we have
800.
10,800. So let's come here. That particular one, we have to ask ourselves if that has been recorded. Okay, if that has been recorded. So we'll be looking at that issue now and see if it has been recorded. If nothing has been said about it, it means that it has been recorded in the what? In the financial statement. And that is why they are saying that, look at this one. They are saying that investment including what? Loan to what? Okay, so the cash of 10,800 has been included in the investment. So we go and remove it because we are canceling that with what? So we come here, the investment of 10,800, unless the question is saying that this has not been recorded. If the question is silent, it means that it has been recorded and it is in their investment. So just take the remaining part of those ones. Let's move on.
Okay, so prior to the acquisition, Haidan had been experiencing difficulties with the supply of components that it used in its manufacturing process. Systan is one of Haidan's main suppliers, and the acquisition was motivated by the need to secure supplies. In order to finance an increase in the production capacity of Systan, Haidan made a non-dated loan at the acquisition date of 4 million Ghana cedis to Systan that carried an actual and effective interest rate of 10% per annum. The interest to 31st March 2014 on this loan has been paid by Systan and accounted for by both parties. The summarized draft financial statements of the companies are.
Okay, so let's come here. They say they have been given, loan has been given what? At the date of
To Systan.
they have given a loan to what? To the subsidiary. Can you give loan to your own company?
No, sir.
No,
So what do we do on that?
We
Cancel it
actually
all.
reverse it.
Okay, so what we do is let's come here. Since we have identified the subsidiary now, let's add their PP figures now. What is the PP figure for the subsidiary?
9,500.
Okay. Do they have any investment there?
No.
No.
Okay. What is the value of their current assets?
7,200.
7,200. Their share premium will be consumed. All their equity items will be cancelled with the investment, and we have done that already. So let's come to their. Do they have a 7% bank loan?
No, sir.
No.
Okay. Do they have the 10% loan notes?
Yes, sir.
That will be 4,000,
4,000.
isn't it?
Yes, sir.
Okay. And their current liabilities is what?
3,900.
Okay. So you can see that the 10% loan note is the same loan note that they are also taking from what? From the parent, isn't it?
Yes, sir.
Okay, let's come here. So this, we have to remove the loan now. We have to take the 4,000 because you can't give loan to your own company. Okay, so we also have to come here. The loan is included in the what? In the investments. Okay, let's come here. What has been done? They say the interest has been paid on the loan, isn't it?
Yes, sir.
Okay, we have acquired the subsidiary for how many months? Okay, let me
6 months.
It's
6
6 months.
months.
Okay, so that is 6 months. So let's calculate the interest on the loan. The interest that was paid on the loan, the interest on the loan, interest on loan will be interest on loan will be 0.1 multiplied by 4,000 multiplied by 6/12. Do you agree?
Yes.
Yes,
Okay.
sir.
What are we having?
200.
That will give us 200, isn't it?
Yes.
Okay. This 200 has been included in what?
Investment.
In the investment income of what? The interest income of what? Of the
Yeah.
parents. That should be removed, isn't it?
Yeah.
Okay. The 200 is also the finance cost of the subsidiary, but we come back later and adjust that particular one. We come back later and adjust that particular one. Please look at this. Okay. Before please don't go here. Someone is saying that why didn't we adjust the subsidiary figure by 6 months? Because we know that we acquired them for 6 months. It should have been 6/12 multiplied by their revenue and other figures, isn't it? Okay.
Mm.
Why I didn't do that? Why am I relaxing? Am I relaxing because I want to teach you a different thing? Okay, let's come here. The we come here, then you know why we are not what? We are not subtracting that 5, that 6/12 plus that figure. Okay, so we have actually reversed that particular interest part, left with the subsidiary part. We come and remove it, but that will be done at a particular, or we have to wait before we do that one. Let's come to the net asset of the subsidiary. So the net asset over here, we are also going to be looking at the finance cost over here. The finance cost was taken from their profit for the year, isn't it? And we are reversing
sir.
it. So the 200 must be added to the profit back under the what? Under the net assets. So we will be doing the two simultaneously. This is how we do the two. Anything that you are doing in the statement of profit or loss, you still pass those entries that should have been passed under the net asset if you are doing statement of financial position. So we are reversing the finance cost of 200. It was treated as cost. Now we are reversing the transaction. So no loan has been taken. So we should not pay the interest to that particular parent. You come here. Let's have the parent group retain earnings. What is the figure for the parents?
20,000.
Okay, that will be 20,000. 20,000. We also reverse the interest income, isn't it? Okay.
Yes, sir.
Sorry, we are not passing it together. The interest income was also included in the retained earnings because the retained earnings is the retained earnings at the beginning plus the profit for the year, and the parent has included the 200 in their investment income, which is part of the retained earnings. Although we are doing it for profit or loss, but since we have to show the group retained earnings in the statement of financial position, we have to adjust this one also separately. Okay, so we come over here and reverse the one. We have reversed the loan and we have reversed the transaction relating to the loan also. Let's come to the footnote now. We are done with the top there. Let's come to the footnote now and deal with these issues. Yeah.
The following information is relevant. At the date of acquisition, the fair values of Systems property, plant and equipment were 1.2 million Ghana cedis in excess of their carrying amounts. The property, plant and equipment has a remaining useful life of 2 years at acquisition. System has not adjusted its assets to fair value.
Okay, this one is the fair value, is it upward adjustment or downward?
An upward adjustment.
Okay, this is just like a revaluation. When you revalue an asset, what will happen? The asset value will increase and the revaluation surplus will increase, isn't it?
Yes, sir.
Yeah.
So this is just like a revaluation. So let me just give you the tip. Just assume that we are revaluing the asset at the acquisition day. So if you revalue the assets, revaluation surplus will increase and the asset value will also increase. So we come here, we increase the asset by 1,200, and we increase our net asset by what? So PPE, that will be 1,200. And this particular revaluation, it will be taken to the closing also. So it will be the opening to the closing. Okay. Let's come here. This asset, the revaluation was done at what, 1st October. When are we reporting?
31st March.
Okay, so it means that after the revaluation, we have used the asset for how many months?
For 6 months.
For 6 months. But it was the depreciation charge for the 6 months?
No, sir.
No.
Okay, so we now charge the depreciation. We now have additional depreciation over here. Okay, so depreciation would have been charged. So dash, what would be the 6-month depreciation? Let's go and do it somewhere. So we have the depreciation. Depreciation will be 1,200 divided by 2 multiplied by 6 over 12. Is that correct?
Yes.
Yes, sir.
Then we have 300, isn't it?
Yes.
Okay. This 300 will be taken away from the profits. Okay. But since we are doing statement of profit or loss also, that 300 will be added to cost of sales. I hope you're okay with that. Okay. That depreciation has not been charged. So we come and what? It should be taken from profit. So we add it to our, this thing now, we add it to our cost of sales, taking it away from the profit. This is how we do the two. So if you are doing the two, this is how we go about it. You adjust it one by one. Charles, can you take the second one for us now?
Okay, so
Sir,
I
please, sorry, please, can you come again with the depreciation? We took it from the PPE, we added it to the PPE, and then where again?
Okay, sorry, thank you for reminding me. Depreciation should be taken away from the PP. Okay, okay. So what you do is the fair value adjustment is just like a revaluation, and your revaluation surplus is under the net asset at acquisition. So you increase the net asset, and increase the value of the asset also. Okay. After that one, you have used the asset for 6 months. So you need to charge a depreciation, and the depreciation is supposed to go to profit or loss. So you send it under, depreciation will be under, we add it to cost of sales.
Cost of sales, okay.
Okay. But since we are doing statement of financial position, also it means that the profit is under the what? Under the net asset are reporting. So we go and take it over there. So since we are doing the two, we do the two simultaneously. If you are doing profit or loss, you add it to cost of sales and take it away from the asset because the value of the asset will reduce by that figure. Okay.
Yeah,
But you assume that you are not doing statement of profit or loss. Then the profit for the year is under what? Under the net asset are reporting. So you go and subtract it from that one. So we just combine the two, or if you are coming to combining the two, this is how we go about it. I hope you're okay now.
Yes, thank you.
All right. Just take the.
Okay.
All right.
For the purpose of determining the acquisition date net assets, system generated an interim account covering the first half of 2013. Provided below is system's interim profit or loss accounted for the half year ending 1st October 2013. So we have revenue, cost of sales, gross profits, operating expenses, interest income, finance costs, resulting in a profit before tax of 4,800, and then an income tax of 1,200 deducted.
Oh, you forget about that figure. Forget about those figures. Okay. What they are saying is that this is a trading result for what? For the first 6 months, isn't it?
Yes, sir.
Okay. Let's come to the retained earnings over here. Okay. Let's come to the retained earnings of the what? The retained earnings of the subsidiary at reporting is what?
6,300.
Okay, 6,300, isn't it?
Yes, sir.
Okay. How was that particular figure? How was the 6,300 gotten? It was opening retained earnings plus 600 profit made for the year, isn't it?
Yes, sir.
Okay.
Yes, sir.
That was how it was gotten, isn't it?
Yes, sir.
Okay. So we want to determine the retained earnings at the start of the year. How do we determine the retained earnings at the start of the year?
We take the profits from this closing retained earnings.
So 6,300 minus what? Minus 600, isn't it? 6,300 minus 600, is that correct? 6,300 minus 600. This one is a profit
Yeah.
for the year.
Okay, okay.
Are we okay with that?
Yes, sir. Yes.
Okay. That is the retained earnings from the start of the year, isn't it?
Yes, sir.
Okay. We have acquired them for 6 months, and they are saying that the profit or loss, they have generated a profit or loss result for the first 6 months, and that show a profit of how much?
3,600.
So it means that up to 1st October, we are going to be having the opening retained earnings, that is a retained earnings at the beginning of the year, plus the profit of 6 months, that is 3,600. What will be the retained earnings at acquisition? What is the retained earnings at acquisition?
9,300.
9,000.
9,300.
Okay. What it means is that during the post-acquisition period, it was a loss that was made, isn't it?
Yes, sir.
Because we have what? We have 3,600 for the first 6 months. Now we are having 600 for the full year. It means that a loss of what? A loss of 3,000 has been made during the post-acquisition period. Can
Yes,
someone
sir.
confirm that for me? A loss of 3,000 has been made during the what? During the
Yes, sir.
post-acquisition period, and that can be demonstrated over here.
Yes, sir.
Okay, let's come to this one. Let's come to the trading items now. Very simple. Okay, I've done this question to explain something, because the time that I was writing crypto reporting, they have given us a particular question that if you are not very smart, you just be there. You can go and check the console questions for 2021. Okay, so they have to, if you are not very smart in mathematics, okay, that is a pure mathematics. They have given you the group figures, and they have asked you to calculate the parent, the subsidiary figures. So you just have to know that you add the parent and the subsidiary figure with other adjustment to get a group. So for you to get the subsidiary figure, you have to subtract the parent figure and also those adjustments that you have to do. So you have to get that one. Okay, you know that the total is the parent plus the subsidiary minus certain adjustments, and you have to get the group. Now they have given you the group. It will now be the group minus the parent plus or minus the adjustment that will give you the what? The subsidiary figure. So that is what they have done. You can check that one out. May 2021. Okay. So let's come here. Please, these figures over here, these figures over here, these figures for the sextant, they are figures for the full year. They are 12-month figures. They are 12-month what? Figures. I hope you're okay with that.
Yes, sir.
Yes.
Okay. But we are only interested in the what? In the activities from what? From 1st October to the end of the year. We are interested in only the 6 months, because the first 6 months we don't have control over them, so we can't have share of that profit. So let's come here. The total revenue for the year is 59,200. That is for the year. Let's go to the revenue that was made for the first 6 months. Let's look at the revenue that was made for the first 6 months. Okay. What was the revenue for the first 6 months?
24,000.
24,000.
So if the total revenue is 59,200, what would be the revenue for from October to what? To March?
That's half. 29,600.
No, please.
Okay.
It's going to be 18,400 minus 24,000.
I got 35,200. 35,200.
Thank you.
Yes, the same.
The total result for the 12 months is 59,200.
5,200.
Okay. The 12 months is 59,200. They say the first 6 months is 24,000. This is 6 months plus 6 months. So if the first 6 months is 24,000, how much will be for the next 6 months, so that we have a total result of 59,200? That will be 35,200. So for you to get the post-acquisition figure, you just subtract the pre-acquisition figure from the what? From the total figures. So the revenue will be 35,200. Okay. Revenue will be 35,200. So we come here and have our revenue of 35,200. Okay. What will be our cost of sales? Okay, let me go there. Our cost of sales will be what? 18,000 against what?
31,000,
18,000 against 49. That will be 31, isn't it?
49,000.
Okay.
Yes.
So that will be 31,000. That will be 31,000. Let's go to operating expenses. Operating expenses is 9,200 against
8,000,
what? Against,
1,200.
okay, that will give us 8,000, isn't it?
9. Yes, 8,000.
Okay, so that will give us 8,000. Operating expenses will be 8,000. Please, you have to wait and
Income
confirm.
is 0.
If we don't have any issue like this, we just do 6/12 multiplied by the total revenue. But they can actually trick you with this one like this. Okay, let's come to their interest income. Do they have any interest income?
No.
No, sir.
Okay, but let's count to what is the finance cost for the year?
200.
200.
And what is the finance cost for the first 6 months?
0
So it means that the finance cost over there is for what?
for the parent.
Is for
The
no
one,
It's for the full year.
no, it's for the
loan.
6
full
months, which is
year.
no,
It's for the 6 months.
it's for the 6 months which relate to the loan. That is the loan figure.
Yes.
That is the interest on the loan. Are you okay now? So we
Yes,
have
sir.
over here,
Okay.
that is, so that they don't have anything over there. So you come over here and have 200 minus 200. Do you agree? Plus
Yeah.
200 minus 200. So
Yes, sir.
you add it and subtract it because you have to reverse that particular transaction. Okay. Do they have any other profit or loss item? Okay.
No, sir.
Okay. So income tax is what? Income tax expense. Income tax is what?
They had 200.
1,200.
You have 1,200. But what is the figure over there?
200.
200. So it means that, let's come here. Pay attention to this place. We are having a tax expense of 1,200, isn't it?
Yes.
Yes, sir.
But this figure has now reduced to what? Has now reduced to 200. What is happening within the 6 months? Within the last 6 months?
Tax relief.
There's a
Tax relief of
how
1,000.
much? Of 1,000. Thank you. So there was a tax relief or tax benefit of 1,000. So what we do is that the tax relief will be a reduction to this one, isn't it?
Yeah.
So it's not a tax expense. We don't have to add. It's a relief. It's a benefit. So during the post-acquisition period, they have given us a tax benefit of what? Of 1,000. Okay. They have given us a tax benefit of 1,000. Are we okay with that?
Yes, sir.
Okay. So let's take the other adjustment now. Please, if this is not given, you just assume that the profit or loss have accrued evenly throughout the what? Throughout the year. Let's come to the IIINC.
III.
Yeah.
In the post-acquisition period, Sistan sales to Hayden were 30 million, on which Sistan had made a consistent profit of 5% of the selling price. Of these goods, 4.5 million, that is at cost price to Hayden, were still in the inventory of Hayden at 31st March 2014. Hayden incurred a delivery cost of 0.5 million on the goods bought from Sistan, which added to the closing inventory at the reporting date. This had not affected the closing inventory sent to income statements for the year. Prior to its acquisition, Sistan made all its sales at a uniform gross profit margin.
Okay, let's come here. We are doing profit or loss. So the first thing that we have to do is what? We are doing profit or loss. The first thing that we have to do is what?
Reverse the trade.
Okay, reverse the what? The revenue. So we go to cost of sales 30 million. And so we do revenue 30 million and cost of sales also what? 30 million.
30 million.
So the next thing that we have to do is to determine what?
Realized profit.
Okay. So they say that the profit charge on this particular figure is 5%, isn't it?
Yes, sir.
Yes.
Okay, so it's Sexton had what? A consistent profit of 5% of the selling price of these goods, 4.5 million at cost price to Hedden. Who is buying? The parent is the one that they are selling to, isn't it?
Yes, sir.
Yes.
So the cost price of the parent is the selling price for what?
For the subsidiary.
Okay, so the
Yes.
4.5 over there is a selling price to what? To the subsidiary. So let's calculate provision for unrealized profit on that one now. Provision for unrealized profit. Provision for unrealized profit will be 0.05
05.
multiplied by 4,500, isn't it?
Yes.
What are we having?
225.
225. So this will be added to what? Cost of sales, and will be taken away from what? From
Net assets.
so we are doing the net asset also. So we come here, the subsidiary is the one selling. So assuming we are not doing profit or loss, we have to come and take the 225 from this one. This is included in inventory. So we come here and take the 225 from the inventory. I hope that is okay. Okay.
Yes.
Let's look at the other part of this issue now. That's a very important issue that we have to address over there. They say the parents incurred a delivery cost of what? 0.5 million on these goods bought from what? Bought from the subsidiary, which added to the closing inventory at the reporting date. This has not affected the closing inventory sent to income statement for the year ended. So it means that the figure that we are calculating on realized profit on should be the same figure, because they say 49 million of these goods, so that is 4.5 million of the goods is actually the goods left, and that is what we have sent to profit to the what? To the statement of what? Profit or loss as a closing stock. Okay. But they are saying that Hayden incurred a delivery cost of 0.5 million on the goods bought from the subsidiary. Okay. And this has been added to the closing inventory at reporting date. So the 500 over there is part of the inventory that they have in their statement of financial position. You see, they are adding this because if you are selling, any cost that you incur necessary to bring the inventory to the state that you sell have to be added to the cost of the inventory, isn't it? So that's why they are adding it to this one. But this one, at the group level, are they selling? If you are giving goods to me to sell, if I incur any cost, who is going to be taking the cost? If the parent is transferring goods to the branch to sell, and the branch incur delivery cost, who is going to be taking the delivery cost?
The parents.
Okay.
The parents.
So let's come here. Who is going to be taking the delivery cost in this particular transaction?
The subsidiary.
The subsidiary.
Okay.
Subsidiary.
So this particular delivery cost should be treated as well as an expense, isn't it?
Mhm.
So we come here. That 500 should not be added to inventory because the inventory is within the group. The parent is not buying. The parent is not a third party. If it should be a third party, yes, the third party can actually capitalize the delivery cost because it's a cost necessary to bring the inventory to the situation that they can sell it. Okay. But this one, the delivery cost will be incurred or will be borne by the person transferring the item. So that should not be part of inventory. So that should be expensed. So the delivery cost will be given to the subsidiary now as an expense. So since you are doing profit or loss, you add it to operating cost. If you are not doing profit or loss, it means that that figure should be treated as what? As an expense for the what? For the subsidiary, which will be taken from their profit at what? At reporting. How that is okay?
Sir, please take it again from me.
Yes. So just so you'll be there and say that for consolidation there is nothing that you cannot adjust. See. So the only way that you can master is to practice and also understand the issue. Okay. Just if you are giving goods to me to sell for you and I've incurred delivery costs, what are you going to be doing? You
Capitalize.
No. You are giving goods to sell for you and I've incurred delivery costs. What am I going to be doing? I will tell you that I've incurred this cost and you pay me, isn't it? Because the goods are
Yes,
not
sir.
mine. I'm not buying. You are giving the goods to me to sell for you. Are you okay? So
Yes, sir.
you are the one who has to take this particular, you are the one who has to take this particular one and give me the money. But what I'm doing is that I'm adding it to inventory. No, you have to incur this cost as an expense. But the parent has added this one to inventory. It should not be added to inventory because the parent is not a third party buying. The parent is part of the group. So the two entities are seen as a single entity. So you cannot transfer goods to your own self and still have a delivery cost because you have purchased the goods already. You have purchased the goods already. There is no cost incurred. You are not giving it to those people. You are not what? You are not buying the item. So delivery cost should not be capitalized. But the parent has capitalized the delivery cost. The delivery cost should be taken by the subsidiary as an expense. So since they have added it to inventory, we are going to be removing it from inventory and now treat it as an expense. Treating it as an expense means that we'll be adding it to operating expenses in the statement of profit or loss. What if we are not doing statement of profit or loss? The profit for the subsidiary is under the net asset. So we come and subtract the expense from what? From the reporting figure.
Thank you, sir.
All right. So let's take what again do we have over there? What again do we have over there? And we move on.
Sir.
Yes, ma'am.
So then this question, then the 500 shouldn't be taken from the net assets, the delivery cost, since we've already taken it from the operating expense.
The operating expense, okay? We are doing that because of what? We are doing that because we are doing profit or loss. Let's come here. What is the profit made for the year? The profit made for the year, the loss made for the year is 3,000, isn't it?
Yes, sir.
Which is over here. This loss is before taking into consideration any what? Acquisition adjustment, isn't it?
Yes.
So
Yes, sir.
that this 3,000, it is before the acquisition adjustment. So we have to come and do the acquisition adjustment. The same thing that we are doing over here. You see the adjustment that we are doing over here, whatever we are going to be having over here, if you put their figure, they are also going to be having a loss over here. But this loss is before taking into consideration depreciation, the provision for unrealized profit, and this one. So it's the same thing that we are adjusting over here. We are just adjusting this thing against what? The 3,000 also. So the figure that we are going to be having over here will not be what? Will not be the 3,000. So we are doing the net asset as if the statement of profit is or loss is not there. We are doing the net asset for statement of financial position, not for statement of profit or loss. So the profit that we are going to be getting over here for the parent will be the same. The profit that we are going to be getting over here for the subsidiary will be the same profit that we are going to be getting under the net asset. If we are done with it, you'll be getting the same thing. But we are doing it as if we are not doing profit or loss. So we are doing only statement of financial position where we are looking for the post-acquisition profit. So if you are doing the combination, this is how you do it. The net asset is being done for statement of financial position, not statement of profit or loss. Okay. Just can you
Okay, so Ivy, immediately after the acquisition of Sentinel on first.
I've edited this one. It is a footnote that I've added. It should be immediately after the acquisition of Sestan. Okay.
Okay. So 4. Immediately after the acquisition of Sestan on 1st January 2014, Hydan transferred an item of plant with a carrying amount of 4 million to Sestan at an agreed value of 5 million. At this date, the plant had a remaining useful life of 2.5 years. Hydan had included the profit of this transfer as a reduction in its depreciation costs. All depreciation is charged to cost of sales.
Okay. So what are they saying? They are saying that is intra-group what? Transfer of
PP.
But we are saying that the transfer should not be done. You cannot say that you are selling to your own what? So you can see that this one, they are giving the Hydan is giving the items to what?
To Sestan at a fair value.
Okay, but if you have an asset, okay, if you have an asset that you want to give it to your branch, are you going to be giving it to them at fair value? The asset is measured at cost model. Okay. Any adjustment to transaction like this, it is assumed that the asset is measured at cost model. So we don't fair value. So just if you are using a car, okay, and I'm your brother, you are using a car, I'm your brother, and you want to give the car to me, are you going to be selling the car to me? We are related. You just
No,
give the
sir.
car to me that I should use it. It means that you are giving the car to me at the carrying value. You are giving the car to me that you have remaining 2 years to use the car, so I should use it for the 2 years. So what will happen over here is that it is the subsidiary that is occupying the what? The what? It is occupying or using the asset. The subsidiary is using the asset on behalf of the parent. It's just like the parent is using the same asset through the subsidiary. So what will happen? The parent has to give the subsidiary the asset at what? At their carrying value, the remaining value. So we have 4 million, 4 million. Okay. The asset has the value that we have to consume on the asset, remaining value is 4 million. So if we want to use it ourselves, we just occupy it and use the 4 million out of it. The subsidiary want to use it. So subsidiary is part of the parent. So the subsidiary will just occupy at the 4 million. The subsidiary is using the asset on behalf of the parent. You cannot sell, you cannot transfer to your own organization, or you cannot sell to them. You cannot sell an asset to them. You just give the asset to them or use it. We are not using it, so use this particular one. So the transfer should always be done at carrying value, but they are doing the transfer at what? At fair value of 5 million. It means that the parent is having what? The parent is charging a gain of what? 1 million on this transaction. The parent is having 1 million gain on this particular transaction. What do we have to do?
We have to reverse
We have
this
to
gain.
reverse it.
Okay, so it means that the transfer should be done at what?
At cost.
So the parent has
At
charged
cost.
that. The parent has charged us. The parent has charged that particular amount as a reduction to depreciation, isn't it?
Yes, sir.
And depreciation is charged to cost of sales. So it means that
Of
they have
sales.
removed 1,000. So we come and add 1,000 back. Is that okay?
Yeah.
Yes, sir.
Okay. The 1,000 depreciation should have been that particular figure, but they have taken the 1,000. The 1,000 should not be taken. Okay. Now we go. Assuming we are not doing statement of financial position, this gain should be taken away from what?
Yeah, retain earnings.
Retained earnings, because the profit for the year is retained earnings. So we come here. The subsidiary is carrying the asset at 5,000, isn't it?
Yes, sir.
So we have to reduce the asset now to what?
4,000.
4,000. Okay, let's come to this particular issue. Very interesting one. Okay. So what was the depreciation charge by the subsidiary? What was the depreciation charge? The depreciation was charged on what? On the 5 million, isn't it?
Yes, sir.
5,000 over 2 multiplied by 3 over 12. Are we okay with that? January to March, that is 3 months. The asset is
So it
having
was
2.5 years.
2.5 years.
Okay, 2.5. So 5,000 divided by 2.5 multiplied by 3 over 12. What was the depreciation charge by the subsidiary?
500.
Okay. But what should be the depreciation charge? So we have to look at what should be the depreciation that would have been charged. The depreciation would have been 4,000 divided by 2.5 multiplied by what? 3 over 12, isn't it?
Yes, sir.
That will give us how much?
400.
Okay. So what is happening over here? There have been
Excess depreciation of 100.
okay. Sometimes they will not give you the carrying value and the what? They will not give you the carrying value and the fair value. They will just give you the gain. Okay. So the meaning is this was a depreciation charge. They have charged depreciation of 4,000 over 2.5. Okay. Plus depreciation of 1,000 over 2.5. All of them multiplied by 3 over 12. Do we agree to this particular one as the depreciation like this? The 5,000 depreciation, do we agree that this was the
Yes.
depreciation?
Yes, sir.
Okay.
Yeah.
So the depreciation should be charged on only the 4,000. So they have overcharged depreciation on 1,000. So the excess depreciation, you just calculate it on the gain. The gain of 1,000 should not be part of the asset, but you have included it. So it means that you have to now charge the depreciation on that 2.5, 3 over 12. And that will now give us what? 100. Okay. So instead of charging depreciation of 400, they have charged 500. So what will happen? We go to their net assets here. Net assets, assuming we are not doing profit or loss, we now have excess depreciation of 100. We reverse 100 back. But since you are doing profit or loss, this is what you do. You come and subtract the 100 for the depreciation back, because 500 is included over here, but 400 should be the depreciation. Let's come here. The next entry will be the asset. I will show why we should take that value from the asset. Okay. In the books of the subsidiary, this is how they are showing in their books. In the PP over there, they are having this 5,000 minus 500 relating to the asset. Do you agree?
Yes, sir.
So they have 5,000, then they have charged depreciation on the 5,000. So this is the value that they are having in their what? In their books. Okay. But what are we
Yes.
doing? We are removing the 1,000 to bring the asset back to what? To the 4,000, isn't it?
Cost. Yes.
Okay.
Yes, sir.
So if we are bringing the asset back, you can see that this will be 4,000 minus 500. Do you agree?
Yes, sir.
If we are subtracting 1,000, it will now be 5,000 minus 1,000. That will be 4,000. 4,000 minus 500. If we are bringing the asset back to 4,000, the depreciation would have been what? 400, isn't it?
400, yeah.
But you are subtracting 500, so you have to add 100 back to now neutralize that particular effect. So the excess depreciation will be what? Will be between the net asset and then the asset. We come and add this 100 back to neutralize the effect of what? The excess depreciation that has been charged to the net asset as a net asset to the PPE. Okay, that is for that one. Please pay attention to this one very well. How do you go about it? There should not be sell. So you remove the gain. You remove all the transaction that has been done. So you remove all the gain. Okay, how do we remove the gain? Or let me just show you alternative way of doing this. Okay, let's come here. What is the carrying value in the books of the subsidiary? What will be the carrying value based on the depreciation charge? Their carrying value would have been 5,000 minus 500. That will give us 4,500.
4,500.
Okay, but what should be the carrying value? It should have been 3,600.
3,600.
Okay, minus 400. That will be 3,600. What is happening there? It means that they have included 900 in excess of this amount, isn't it?
Yes, sir.
So go to PP and remove the 900. So if you come over here, you can see that we are removing a net amount of 900. Negative 1,000 plus 100. That is negative what? 900, isn't it?
Yes, sir.
Yeah.
Okay. So it is a 900 that we are removing. Then you just do the excess depreciation also separately. The depreciation was charged on what? On the fair value of 5,000. The subsidiary has charged depreciation on the 5,000 up to the reporting date, but the depreciation should have been on 4,000. The depreciation should have been on 4,000. So it means that they have overcharged the depreciation. They have overcharged depreciation on 1,000, which is a gain. So you calculate depreciation and reverse that particular one. And I'm saying that most of the times they will not give you the carrying value and then the fair value. So you just remove the gain from the retained earnings of the parents and the asset. Then you calculate the excess depreciation, the depreciation that the subsidiary or the parent is overcharging. You calculate it. The depreciation was taken from their profit. So you go and add it back to their profit, and you add it back to the asset also, because the asset is also good. The over depreciation was taken from the value of the asset. Okay, that is for that particular one. We have passed this entry, excess depreciation, and the gain over there was taken, and that is just take the
5. Included in Haidan's current liabilities is 1 million Ghana cedis owing to Sistan. This agreed with Sistan's receivables ledger balance for Haidan at the year end.
So what are they saying there? That is intra-group what?
Intra-group balances.
So what do? It means that
We just set them off.
Okay.
We net them off.
So in the current assets, that person is having 1,000, and the same thing they're also having 1,000. There should not be owings among themselves. They are single entity, so that will be 1,000. That is okay. So you also pay attention to that one. That's also an area that you can actually. So I've put all the necessary adjustments in one question so that maybe if we don't solve plenty, you can actually be able to find your way around it. Okay.
Then
VI.
please come again with that figure. That's entry, the 1 million that we took.
You move from receivables and payables.
Okay.
Okay.
Okay. Yeah.
VI. An impairment review of the consolidated goodwill at 31st March 2014 revealed that its current value was 375,000 less than its carrying amount.
Okay. So an impairment review of consolidated goodwill at 31 March revealed that its current value was what? 375 less than its carrying value. What are they telling you?
So the goodwill we are going to calculate has impaired by 375,000.
Okay. The goodwill has impaired by 375.
375,000.
Okay.
Yeah.
So goodwill impairment is an expense. If nothing has been said, you add it to what? 375. Please, the goodwill impairment should not be pro rata because then the goodwill will be calculated from acquisition date. So the impairment is for acquisition. The impairment is from acquisition to the reporting date. Okay. The impairment is from acquisition to reporting date. If we are doing statement of financial position, what are we going to be doing? This impairment will be shared among what? Okay. The NCI and the parent, because the question is saying that they are using fair value. So we have 0.6 multiplied by 375. Okay. So the last part is saying that they are using fair value. So you can take the last part.
Okay. It is Highlands Group policy to measure the non-controlling interest at fair value. At the date of acquisition of Sistan, the fair value of a 40% holding was 5.5 million.
So you count to fair value of NCI at acquisition. So that will be 5,500, isn't it?
Yes, sir.
So we have the share of impairment now. Okay, the share of impairment will be 0.4 multiplied by 375. Please, if the NCA is measured at proportionate method, the impairment of the goodwill is for only the what? Only the parents. Okay. So it means that NCA is not having any share of the impairment. NCA is not having any share of the impairment. Please, can we calculate the share of the impairment for?
Yes. So the parent is 225. Subsidiary is 150.
So 225 and 150. Okay, I will show you why the impairment will be shared among the NCA and the parent. So we have the NCA here to be 5,500. Okay, can we have the net asset at acquisition? Can you put the net asset at acquisition? What will be the value of the net asset at acquisition for them?
13,000.
1,200 is also there.
Yes, sir.
Okay, so that will give us 13,000. 13,000 per. Okay,
Yes,
so
sir.
we have 13,000 here. What will be the goodwill at acquisition? Would that be 3,300?
Yes, sir.
Yeah.
3,300.
But they say this has impaired by what?
375.
375.
So impairment of 375. What will be the answer?
2925.
2925.
25.
Okay, so you go to your statement of financial position, then your goodwill will now be working straight. Then you have 2925. Okay, so we don't have any other thing to do. Can we add these figures? So this will be 13,000. Reporting will be what?
9275.
9275.
75.
75.
Okay, 9275. Okay. So what will be the post-acquisition loss?
3725.
3725.
25.
Okay, so we have the share of post-acquisition profit. That will be 0.4 multiplied by 3725. Okay,
1490.
share of post-acquisition loss 0.6 multiplied by 3725.
2235.
2235.
35.
Okay, 2235. This will give us what?
1490.
1490. Okay, so you can actually total that figure, but let's go to our statement of profit or loss. Okay, so the statement of profit or loss, what are the figures that we are going to be having? Can someone add those figures for us? This will be dash, profit before tax. What are we going to be having? Then I'll also be doing the share of the profit. You will see that the share of the profit of the, you look at the share of the profit of the this one, the loss will still be the same as 3725. Okay, revenue is what? 98,000. 98,000 plus 5,200. I'm having 103,200.
103200.
Okay, 103,200. Okay. And 3,200 times plus 200, additional depreciation 200, 225, the root cost, this is depreciation. The root cost, this one, what's the depreciation?
78425.
7,
8425.
okay, 78425. What is the difference? What is the gross profit?
24775.
24775, isn't it?
Yes.
Okay. Operating expenses,
20675.
20675.
675.
Okay. Interest income is what?
150.
Okay. 150. Finance cost will give us 420, isn't it?
Yes, sir.
Okay. So that will give us 420 here. Share of associate profit is dash. Okay. What will be the profit before tax?
3830.
3830.
30.
Okay. So let's come to tax over there. What is the tax? What will be the net tax?
3,200.
Okay, 3,200. Okay, what are we having?
630.
Hey, the two figures for
Six.
them. Okay.
Yes.
Sir,
Yes, please.
the operating expense, please check it again.
What are you having?
The figure they got is different from what I'm getting.
Mention your own.
10675.
The first one is 11,800.
She's using
Oh,
8,000 as 800. She's using the 8,000 as 800.
no, is a I wrote
The 11.
I used 1,800 instead. Okay.
Ayo. Okay, so let's come to the profit attributable to. So we share this particular profit among them. Profit attributable to. So we have the parent over here. Then we have the NCI. Sorry, NCI will be at the down. We always start with the NCI. Okay, what was the post-acquisition profit? It was a loss of 3,000, isn't it?
Yes.
Okay, it was a loss of 3,000. But
You
this
can-
particular one was before some certain adjustments, isn't it? Okay,
Yes, sir.
so it means that this is a loss. So post-acquisition, the provision for unrealized profit will come there, which is 225. I hope we can remember that. So you can just come here and bring the adjustment that we have done over here. Or sometimes you will not have this adjustment. We know that excess depreciation of 300 on their asset has been done also. Okay. Then the delivery cost of 500 has also been taken by them. Okay, so let's also go there and see delivery cost post. Okay, then we have reversed what? Finance cost of 200 and excess depreciation of 100. So that will be a reduction now. So we have plus 100, then plus what? 300 minus the impairment. The impairment is on a goodwill to the what? To the subsidiary. So what is the figure that you're having? You should be having 4,100 as a loss.
I'm having 1,300. Negative 1,300.
No,
Oh, hold on.
this is negative. This is negative
Yes, negative 4,000.
300.
Negative
4,100.
4,000.
4,000.
Just
4,000.
4,000.
Yes.
Yes.
Really? What is their post-acquisition profit? Okay, it's 4,000. 3,725. Do you know why we are getting the 4,000? Okay, this is 375. This particular profit, this particular loss is before impairment, isn't it?
Yes, sir.
So the impairment is an expense which should be taken. So you add the impairment back and now have 4,000. So someone can actually share the 4,000 to them, and the person will not share the impairment. We are sharing the impairment because we haven't taken the impairment from the profit. So the profit that we are sharing is profit before impairment. So someone can actually send the impairment to the net asset at reporting and get 4,000 and share. Share 4,000. Do 0.4 multiply by the 4,000 and see what you are going to be getting for the NCI.
1,600.
1,000 what?
600.
600. Okay. Then why 0.4 multiplied by 3,725? Why we are not getting that figure? Are we sure that this figure is the loss?
The 375 and the 375 together will give us 4,001.
4,100.
So why this figure is not giving you, why you are not getting this figure as 4,100? It's supposed to be 4,100. So add it again, 3,000. So this should be 200. The finance cost should be 200, sorry. The reversal of the finance cost is 200. I hope that is okay now. The finance cost
Yes,
the finance income that they are reversing is 200, not 300. So that will give us 4,100, isn't it?
Yes, sir.
Okay, multiply by 4. What are you having?
1540.
15 what?
40.
Okay. So that will give us
1,640.
1640
40.
as a loss, isn't it? Okay. Come to this one. Come to the NCN now and check something there. Okay, look at the NCN now. Add the impairment and this figure and see what you are going to be getting.
1,640.
So that's what I'm saying, that someone can add the impairment. Someone can actually take the impairment from the net asset and reporting and share. We are sharing the impairment because the impairment as an expense has not been taken away from the profit before we are sharing the profit. So the impairment is supposed to reduce the profit. That's why we share the impairment. That's why we share the impairment. Let's come here. I wanted to say something here. Assuming we are using proportionate method, what should be the value of the NCI? if we are using proportionate method, what should be the value of the NCI? That will be 40% of what? Of the
The
13,000. No.
13,000.
Okay, that will give us what? That will give us 5,200, isn't it?
Yes.
Okay, but what is the value of the NCI? It's 5,500.
500.
What is the difference?
300.
So it means that NCA is having, well, where do you think the NCA is getting the 300 from? It means that NCA is having a share of the goodwill. The 300 over there is the goodwill relating to the NCI. So that's why we share the goodwill amount, the impairment amount there. NCA is also having 300 of the goodwill because under normal circumstance, NCA should be having 5,200. But why now 5,500? NCA is having the share of the consolidated goodwill by 300. And this is why we share goodwill impairment to NCA and then the parent if we are using fair value because the NCA is also having the share of the goodwill. So if there is impairment, it means that the impairment of the NCA is also or has also impaired. Okay, but if you should do proportionate method, NCA is not having any share of the goodwill, so the parent will take all. NCA is having a share of only the what? The tangible assets. The parent will be the one to take all of those ones. Okay, so that is how we share the impairment and among the NCI and then the parents. Please, you can put all of them together and now move on. Let's solve that question on interpretation and we close. Okay. Interpretation will be 20 marks and they can give you any question that they want. Are you okay? But they haven't examined common size before, so it will always be about the ratio analysis. Okay. The common size, mostly they give it to corporate reporting people. So this will always be for ratio analysis. Okay. I was thinking if they can give you, sometimes they can give you the ratio for, they can give you a ratio for group accounts where the parent has acquired a subsidiary during the year, and the question will now ask you to calculate the ratio without the result of that. I was thinking maybe they cannot actually give you something like that, but if they should give it to you, we have solved one question like that in class already. So no, I don't think it should be corporate reporting, but anything can happen. If something is happening, you just remove the result of the what of the subsidiary from the parent one and calculate the ratio for the parent separately. They can ask you to do it without the parent and what? Without the subsidiary and also with the subsidiary. We have done something, question number 1, another ratio analysis. So you can actually go back and revise that. Okay, let's look at this one, Charles. Let's look at the ratios that they're asking us to calculate first.
Okay, so operating profit margin, first one. Return on capital employed, with inventory turnover period, current ratio, and then capital into bracket long-term gearing, and then dividend yield.
Okay, so they are asking us to calculate operating profit what?
Operating profit margin.
Okay, for both entities, isn't it?
Yes, sir.
Okay, so this is how you do the ratio. If they are asking you for the ratio, you do it in a table form. Please do it in a table form to save time. So you have your items here, you have your formula, then you have the two entities over here. So let's come here. So you can have your ratios here, you have your formula here, then you have your entities over here. We have the AL and OL. Okay. What is the first figure they're asking us to calculate?
Operating profit margin.
Operating profit what?
Margin.
Okay, operating profit margin is the same as what? Net profit margin. Are you okay? Okay. So this will be net profit before interest and tax. Net profit before what? So operating profit margin. This will be net profit before interest and tax over what? Revenue
Revenue times 100.
Revenue increase
multiplied by
times
100.
100.
Okay. So let's come here. Can we calculate our net profit before interest and tax here? Look at this one. They are saying the net profit figures will arrive after considering, among others, the following items. So it means that what they are trying to tell you that the net profit figure has been arrived after subtracting these items from them. After subtracting these items from the net profit. So what we have to do is that this is the net profit after tax. That's what they are just trying to tell you. Net profit after tax. But we are looking for net profit before interest and tax. Okay. Should depreciation be taken away from the net profit before we get net profit before interest and tax?
Yes.
Okay, so depreciation will not be added back. Should finance costs be taken away?
No.
Okay, so we add the finance cost back. So for the first entity we have 1,500 plus the finance cost of 1050. This will be 1260 plus 880. How that is okay now?
Yeah.
Yes, sir.
Okay, let's come here. You can see that they are giving you issue about deferred tax, IS12. Okay, you can see that they say provision for current tax is what?
1004.
Okay. So we have to determine the current tax or the tax figure that has been taken away from the profit. So the provision was 1104. Okay. Then current tax under provision. What is the impact of the under provision on our tax schedule? It is going to be increasing, isn't it?
Yes, sir.
Yeah.
So we have for the first entity that will be AL and OL. So the current tax is 925. Okay. And under provision is going to be increasing. Under provision is always added to that figure. Then we subtract over provision, but there's no over provision over here. So we have under provision dash over here. This will increase by 332. Decrease in deferred tax provision. What is the impact of decrease in deferred tax provision for 2022? If there is a decrease in provision, it is treated as what?
Assets.
No, we are looking at profit or loss. If there is a decrease
Okay.
in the provision,
So it reduces our tax liability.
decrease in provision is treated as what? As income, isn't it?
Yes, sir.
So the deferred tax decrease, which will be 116 now, and that will be 55 over here. How that is cool. So let's calculate to see the tax figure that has been taken to the profit or loss. So 1104 minus 116. So this will be 988, and this will be what? 925 plus 32 minus 55. That will be 902. Okay, this is how you calculate your distance. But let me do it let me do that one as part of, let me do it as working somewhere. So we having, so let me do it over here as profit. So profit before tax, profit before. So let me just write abbreviation here. Net profit before interest and tax. So we do it for the two companies, A Limited and O Limited. So we look at net profit, which is a profit after tax. What is their respective net profit?
1,500 and 1,260.
1,500 and 1,000.
And 260.
1,260.
Yeah.
So we add back what? Finance cost, isn't it?
Yes, sir.
Okay, finance cost is what?
1,050.
1,050 for these people.
880.
88 what?
0.
0. So we now add our what? Our tax. So we do the workings for the tax somewhere. So we do our current tax that has been taken. We are interested in the tax that has been taken. So we have our tax schedule here for the two entities. So we have the tax schedule. We have the AL and OL. So we always start with the current tax estimate. For the current year, what is the figure for them?
$1,004.
1,004.
Okay. The second entity is what?
925.
925. So there was under provision. Under provision is under which entity?
OL 32.
That was 32. That will be an increase. So you just do it like if you are doing final account, how do you go about it? So we have movement in deferred tax, which is a decrease. Movement in deferred tax is like a provision. So if provision is reducing, movement in deferred tax, which is a decrease, the provision is decreasing. It means that we have to reduce our liability. That is a gain. So this will be treated as a reduction over here. The first one is what?
116.
116.
116. And the second entity is what?
55.
55. So if you find a difference now, what are we having?
888.
So we have
988.
888.
988.
For the first one is 888. The first one is it 888?
It's 888.
Okay, and the second one is what?
902.
Okay, 9.
02.
Okay, 902. So what are we having as our net profit before interest and tax? $34.38. I'm having
3042.
Okay, so let's calculate the ratios for them now. So we have 34 divided by what is their revenue? 3438.
21,900.
3438. Which of them is 21,900?
The second one.
OL.
Okay, 21,900 multiplied by 100. Okay, the first one is
25,600.
25,600 multiplied by
100.
multiplied by 100. What is their respective percentages?
First one is 13.43%.
So 13.43%. And the second one is what?
13.89.
13.89.
13.89%. Okay, so let's go to the next one. The next one is what? Return on what?
Capital employed.
The return on capital employed. The capital employed, what are they saying? They say capital employed defined as what? All interest, liabilities, and what?
And equity.
Equity. Very important. So our capital employed is just like is rosy. So we have the same as net profit before interest and tax divided by the net asset or the capital employed multiplied by what? 100. Okay, multiplied by 100. Okay, so let's count to, we have 34, 38, 30, 42. So we come here and look at their figure now. So let's come here. So they say this should be all interest bearing what? All interest bearing liabilities.
Liabilities.
Okay. And the equity, how do we go about this now? Very interesting one. So what are the interest bearing liabilities here?
We have 15% debenture under current liability.
Okay.
We have
We have
12%
8%
convertible
redeemable
loans.
preference shares. 12%
12% convertible
Loans.
Okay. The two all will be part, isn't it?
Yes, sir.
Yes.
And which one again?
And then the
8% redeemable
8%.
preference shares.
8% redeemable what?
preference shares.
Under financial assets, preference shares are treated as what? As a liability. Preference shares is a financial liability, or preference shareholders are actually creditors. So interest-bearing what? Liabilities. So 8% redeemable preference shares, 12% convertible loan notes. So what you do is, this is the figure that you are going to be getting. So it will be whole of this figure, because we are adding the equity. So whole of this figure plus whole of this figure, isn't it? Then plus
Yes, sir.
5,600. What are we getting for the first one? 13,400 plus 10,510 plus 5,600. I'm getting 295.
510.
Okay, 29510. 29510 multiplied by 100. Let's go to the next person and calculate that for them. Okay, so we have 1,4,700 plus 1,0,137 plus 5,123. 299.
5.23 is payable. So.
Oh, sorry. So 5,123. So 2,4,837.
Yes.
Okay. 2,4,837. So 2,4,837 multiplied by 100. What are we having?
11.65 for the first one.
11.65.
12.25.
12.25. Okay. So let's go to the next one. Next ratio.
Inventory turnover period.
Inventory turnover
Period.
So inventory
Sir.
turnover period, how do we calculate that? Yes, please.
Why did we use all of the figure for equity?
Equity, if they say equity, they are not talking about share capital. Equity is shareholders fund.
Okay. So we have to use all of the figures under equity.
Yes, if they say equity, they are talking about shareholders fund, not share
Okay.
capital.
Okay.
Okay. Please come here. This is not actually what. Okay, this one, let me come here. Let me explain this one. Please, this is not what. This is not a liability. Okay. I want someone to argue why I'm saying it's not a liability. Do you have any points? I'm saying it's not a liability. Don't say that I'm the one teaching you, so you cannot say anything. I'm saying that is not a liability. A 12% convertible loan is not a liability.
Yes, sir.
Why?
Yes, sir. Other components of equity.
So this is the option to convert, isn't it?
Yes, sir.
Yes.
Okay.
It has been splitted.
But since we are using equity, we add all of them. Okay. So at the end of the day, you are not wrong. Okay. At the end of the day, you are not wrong, because it will be the equity plus the long-term one. So plus the interest bearing. Sometimes the question will define the capital employed for you. If it is not defined for you, it is calculated as shareholders fund plus the long-term debt, plus the long-term debt. So if they are saying interest bearing, you have to look for bank overdraft. If there is a bank overdraft, you also add a bank overdraft, because bank overdraft carries what? Interest. Okay. Interest turnover period. As interest turnover, inventory turnover period, how do we calculate it?
Inventory on
Are you going to be doing this in the exam hall?
cost of sales.
Okay.
9.35.
Inventory on cost of sales multiplied by the 365. What are their respective inventories? We just use their closing inventories. 4,600 against 4,200, isn't it?
Yes, sir.
Okay.
Yes, sir.
4,600 first, or
Yes, sir.
okay,
4,200.
against 4,200. We are looking for the cost of sales now. Okay, I want someone to give us the cost of sales. How do we calculate the cost of sales? A very simple exercise there. Okay, we have revenue, but let me come there. Maybe the down will help you to do your cost of sales. Cost of sales for the first one will be what?
Revenue minus gross profit. So
Revenue minus what?
gross profit.
Gross profit.
Okay, but you don't have the gross profit over here. How do we do that?
Using the gross profit margin.
Okay. Do you want to go with
Understand.
that particular long process? The revenue is 100%, isn't it?
Yes.
And the
So okay.
revenue is
So it's
100%.
22.
So that will
So
be
with 22, 122.
no, that will give us cost
So I'm
of sales
getting
is
5, 6.
78% over here, and this will give
Yeah.
us 75%. Okay. Because the revenue that you are making, you are retaining what? 22% of it as a contribution. So it means that you are spending 78 out of it. The revenue is 100%. So if gross profit margin is 22%, you are retaining 22% of what? Of the revenue. It means that you are spending what? 78 out of it. That is how you go about it. So you can just find 78% of the revenue and 75% of the revenue for these people. So what is the figure that we are having there? So I will just have 0.78 multiplied by 25,600. If you want to do it one by one, you find a gross profit first before you do it. That is your own issue. That will be 0.75. 0.75 multiplied by 21,900 multiplied by 365. What are we having?
84 days.
For which one?
First one.
Okay, 84 days.
93 days.
93
Days.
Okay, 93 days. Okay, the next ratio is what?
Current ratio.
Current ratio.
How do we calculate the current ratio?
Current asset over current liability.
Current liabilities.
So we have current assets. Please don't go there and do ratio as a first question, or it will waste your time. So maybe you can do it as a question 4. But if you have the speed, for me, I'm talking, I'm telling you out from experience. If someone tell you that go and do ratio first, you'll be there. They say 1 hour, 1 hour more. You are not done with question 1. Please, the ratio to be at least, let's say, the last question, because it's going to be taking your time. Okay. So maybe if you want to make it the 4th question, fine. But the first question there, my brother, don't try that one. Don't try it. Don't try it. It is going to be taking your time. I'm telling you from experience. Okay. So the current ratio will be current assets or total current assets. Okay. But if you have the speed to do it fast, there's no problem. Okay. If you have someone who has tried that before, the person will tell you that yes, it has wasted his or her time. Okay. Nobody should give you that vim. That if you go do your ratio first, no, my brother, don't do that. Okay. Let's come
Thank
to
you.
the current ratio. The current asset is what? This one, the question will give you the total. So what is the total current assets?
12,900.
So 12,900 against 12,900.
9,790.
90. Okay. The current assets for the second people is what?
10,700.
10,700 over
5,653.
5,600 and what?
53.
53.
Yes.
Okay, what are we having for each of them?
1.32 for the first one.
Okay, 1.32.
32.
Okay, 1.32 for the first one is to 1, and the second one will be
1.89 is to 1.
1.89 is to 1. Okay. The next one is
Yes.
what?
Capital GRE.
Capital GRE. What is that?
Long-term capital.
Long-term.
Long-term capital, the goal.
Capital GRE is a
Non-current
capital position.
liability.
So long-term
liabilities.
Long-term liability divided by long-term liability. So you can just say debt over
Capital.
debt plus equity, isn't it?
Yes.
So we have debt over debt plus what? Plus
Equity.
equity multiplied by what? 100. So let's go and look for our long term. Please, the debt deferred tax should not be part of it. So the debt over here is what? Is 10,510, isn't it?
Yes, sir.
Yes.
The total is 10,510. So we have 10,510 divided by the total of the two. What are we having?
23910.
23,910.
910.
Okay, 23,910 multiplied by 100. What are we having? Okay, the total for this one will give us 10,137, 10,137, 10,137 divided by the total of the two.
Total of the two is 24837.
24,837
837.
multiplied by 100. What are we having?
40.81.
The
For the
first one is
second one,
what?
43.96.
43.96.
96.
Percent, and this is 40.81%.
81.
Okay. The next one is what?
Dividend yield.
Dividend yield.
How do we calculate dividend yield?
Dividend per share over market price.
Dividend per share.
By the market price.
Market.
Okay. So dividend per share over the what? Dividend yield is just like what? Cost of capital under what? Under constant dividends, isn't it? So dividend per share over the market price per share. So we have our what? We have our market price per share, isn't it?
Yes, sir.
We have
Current
our
share
market.
price.
Okay. We have our market price per share, but we don't have our what? We don't have our dividend per share, isn't it?
Yes, sir.
Okay. But they have given you dividend what?
Dividend coverage.
Okay. The dividend coverage is just a dividend cover. How do we calculate dividend cover?
Total earnings or net profits divided by dividend paid.
Net profit divided by
Dividend paid.
Dividend.
net profit is just a net profit or net profit attributable to
Profit after tax.
Yeah.
not just profit
That's what I
after
mean.
tax, profit attributable to the ordinary shareholders
Ordinary shareholders.
over the ordinary dividends multiplied by, or sometimes we do it times, multiplied by times. So the dividend coverage is calculated as earnings per share. Okay, earnings per share divided by dividend per share. Okay, so he's just telling us how many times we can use our earnings. How many times can your earnings pay our what? Our dividends. And then the reciprocal of this is what we call the dividend payout ratio. Okay, so the dividend coverage is just a dividend cover. So it means that we have to calculate our earnings per share and calculate what? Okay, so let's calculate our earnings per share now and see if we can actually do that now. So let's have our earnings per share. Our earnings per share for the two companies. Let's go there. The profit. What is the profit for the first company? What is their profit? It's 1,500, isn't it?
Yes, sir.
So there is no irredeemable. The only thing that we take is irredeemable preference dividends. Redeemable preference dividends are treated as what? As finance costs. They are treated as interest because the redeemable preference share itself are treated as liability. So let's come to these people will be, so for the two companies, one of them will be 1260 divided by, let's count to the number of shares that they have, each of them. What is their number of shares? So we can actually determine that from, so what is the number of shares of the first company? What is their number of shares?
3,000.
That will be 1,500 divided by a number of shares. The total share value divided by the share price. So 5,500 divided by 0.5. That will give us 3,000. So our earnings per share for the first one is 1,500. That will give us 0.5, isn't it?
Yes, sir.
Okay. Let's go to the next one. That will give us 4,200.
4,200.
Okay. So 1,260 divided by 4,200. What are we having?
0.32.
0.3.
0.3. Okay. I'm having 0.3 or 0.32.
Yes,
I
sir.
had 0.3.
I'm also having 0.3. Or Charles, what are you using? Are you using phone or?
Oh, yes. 0.3.
Okay. So our earnings per share is now 0.3. Okay. But we know that our dividend coverage is what? Is earnings per share divided by what? Divided by dividend per share. That will give us what? So what is the answer for the first company? What is the dividend
4.
coverage for them? That is 4, isn't it?
Yes.
Okay. So earnings per share is 0.5 divided by dividend per share, and that will give us 4. So how do we make the dividend per share the subject? Small change of subject over here. We are going to be having dividend per share is equal to 0.5 over what?
4.
Over 4. Okay. So the dividend per share for the second company will also be 0.3 over what? What is their coverage?
5.
Okay. So what are you having?
0.125 for first one.
So 0.5 divided by 4. So we are having 0.125. The second one is what?
0.06.
0.06. Okay. So our dividend yield now, which is calculated as dividend per share over market price per share multiplied by 100. For the two companies, the first one will be 0.125 divided by, what is their market price?
2.1.
2.1. So 2.1 multiplied by 100. Okay, the second one, what is their market price?
1.55.
1.55 multiplied by 100. What are we getting?
5.95.
5.95 for the first one. And the second one is what?
3.87%.
3.87. 3.87%. Okay, so those are the ratios that I just want to, maybe this might be above your level, but I just want to tell you that you can actually mix the ratios and it will ask you have to work some of them to get some of them. Okay. Okay. So let's come to this one. Write a report to the chief executive officer. So report writing. Okay. Charlie, I'm tired. Okay. We have the report. What is the format? You have the to here. You are writing to the chief executive officer, the CEO, from who? So you might be the accountant. The question might be giving you that as accountant. Then you have the date. So the date, you can put a date over there. Then you put a subject. The subject is what you are doing. So analysis of the financial statement of the two companies, or the AL and the OL. So you have your introduction here. So introduction, you introduce the what? The report to them. So you just you find attach the report, the analysis, or the report on analysis of the financial statement of OL, or let me look at that one well and give you. So we are doing this one. Okay, so we are doing fun, or you can say as discussed, I hereby present to you the analysis of the financial performance of AL Limited in relation or relative to what? To OL. Okay. This particular report consider among many things the ratio computed above and other information what other this particular report consider among many things the financial statement presented by two entities and other relevant information relating to the industry that the two entities operate in. Very simple. Okay. Then you come here, you can actually divide these ratios into profitability and other issues. So although the question is not asking you to determine profitability, they are talking about financial performance. Oh, sorry. The question is even telling you for the report writing, use only the following ratios: operating profit margin, return on capital employed, capital gearing, and dividend yield. So what you do is you cannot actually talk about profit again because the question is telling you that you should use these ratios. So you just come here and have, so after the introduction, you have operating profit margin. Okay, operating profit margin. So the operating profit margin, you come and say what you have seen and the reason for what you have seen. Okay, so you come and say what you have seen and the reason for what you have seen. What have you seen? What have you seen? Operating profit margin.
So we can.
Okay.
What are
So
you
I'm
saying?
saying that AL has a relatively higher operating profit margin as compared to OL, and this could be as a result of their net profit before interest being higher than that of OL.
Okay, that this is going to be like for 10 or 14 marks. Okay, what you are saying is correct. Yeah, it's correct, but you have to write plenty to get more marks. If you write that one, the examiner will say this thing is too small. But what you are saying is okay. Okay, but you have to go around some like at least 4 or 5 lines for this one will not be bad. But you don't have to waste time to write plenty. Okay. Okay, so come again, so that you can what you have said over here, you see it in the middle of the everything that you are going to be saying. Okay, it is okay you go straight to the point, but sometimes if the report is too small like that, you might not get the distance because you will see like maybe but at least you can bring some things that are not necessary and at least you are just trying to explain the thing. Okay, so just come again with a different one. Let's see.
Oh, sorry, I wasn't. My mic wasn't on. So the revenues for AL and OL, you could see that AL zone was relatively higher, and then even though their uh, cost, their operating cost was higher as compared to that of OL. Their revenue margin was wider, and as a result, their operating profit was larger than that of OL.
Okay, this thing the reason are on point. Okay, the reason are on point. So yeah, can we have someone to say something about this? We are saying that if you are doing year by year, what do? You compare the increase in the figures, isn't it? I hope you can remember that.
Yes, sir.
If you are doing year by year, or if you are doing over 2 years, then the reason for the change or the reason for the increase will be the change in the two items that you are using. That should be the first point before you bring in another point. I hope we can remember that. Okay, if you are
Yes, sir.
giving 2 years, okay. But let's come to this one. This one we are giving only 1 year, which is the two companies. Okay. So the two companies. Yeah, someone want to talk.
So I was also saying that it could be as a result of their ability to control their operating expenses.
Okay, but the issue is what you are saying is not wrong. The issue is like don't just go straight to the reason. Are you okay? At least you can introduce. I'm not saying that you should explain the ratio. Okay. I'm not saying that you should explain the ratio, but you can just say, okay, AL, okay, OL tends to what? Tends to generate, tends to be very effective in revenue generation, or tends to be very effective in what? In controlling its total cost as compared, or better as compared to what? As compared to AL. Okay, this is because the OL net profit margin is currently at 13.89 against what? 13.43 for what? For AL. Okay, this shows that for every 1 city cell that OL is making, they are able to maintain what? 13.89 pesos, whilst AL is what? Is maintaining only 13.43%. OL is relatively doing better than what? This one, because of their revenue generation is very effective as compared to those ones. This particular performance, or this particular reflection in the performance of OL as compared to AL, can be due to the composition of their direct cost, or the composition of their total cost of the revenue. Okay, their cost ratio, their revenue cost ratio, or the cost revenue ratio is going to be what? Lower than that of what? That of AL. So their cost ratio, you are not giving the total cost. Okay, you are not giving the total cost. They haven't given you the what? The operating profit and other issues. But the reason will be the what? The reason will be the revenue cost ratio, or the cost revenue ratio. So they are having a lower cost ratio as compared to what? To AL. Or you can also say this particular better performance, or OL is doing better than AL because they are able to manage their direct and indirect costs, or they are able to manage their direct costs better than what? Better than this particular one, because their cost to revenue ratio is 75% against what? 78% of what? Of OL or of AL. Okay, so you just have to say what you have seen. Okay, don't go straight to the reason. No, state what you have seen. Okay, from the calculation above, OL tends to perform relatively better in terms of profit, or in terms of profit retention, than what? Than AL. This is because OL net operating profit margin stood at 13.89 against 13.43 of AL. This means that for every 1 Ghana cedi cell that OL is making, they are able to retain 13.89 pesos as compared to AL, who is what? Maintaining, or who is retaining only 13.43. better performance of OL may be attributable to their what? To their revenue cost ratio or their cost revenue ratio. They are able to manage their cost better than AL. This can be what? This can be shown in the what? In their cost to revenue ratio, their cost of sales to revenue ratio. The cost of sales for OL is 75% as against 78% for AL. You are good to go. Whatever reason you are going to be stating, please, there should be something to support it. Don't go there and be saying some things that does not happen. That is not true. Don't be saying that, okay, they have advertised, they are able to carry out advertising, that is why their revenue is increasing. In actual sense, if you look at the revenue of what? AL is more than what? More than OL. But you can see that they are having a higher what? They are having a higher net operating profit. So if you are going to be talking about they have undertaken advertising, that is why this place the revenue over here are different. This one is bigger than this one. What you are saying is a lie. So the reason over here will just be their cost to revenue ratio. Okay, so you just base it on a cost to revenue ratio and what? And okay, their cost to revenue ratio and move on. Okay, the reason over here is the cost to revenue ratio. It's not because they are selling more product, they have increased their selling price. All those things that you are saying will expose you that you are lying because the revenue for AL is higher than that of OL. So if they are engaging in advertising, why their net operating profit margin is lower? The reason is they are incurring more costs. So it is the cost to revenue ratio. That is the difference. Okay. Rosie, what are you seeing for Rosie? Please, we have 11 minutes more. What are you seeing for Rosie? So you also talk about what you have seen for Rosie. Okay. If you come to what? If you come to revenue, what? If you come to the Rosie, the return. Currently, AL is what? Is generating 11.65 pesos for every 1 cedi that the investors are putting in the business. Is that correct?
Yes.
Yes, sir.
Okay. This shows that what? Are they doing better? Are they this if you are comparing this with OL, are they doing better?
OL is doing better than AL.
OL is what? Is doing better. Okay. They are saying that you should analyze the performance of these people in relation to this one. It means that you are going to be comparing. So you compare the performance of what? Two entities, a competitor and the company itself. Or you can compare the performance of single entity over 2 years, or you can compare the performance with industry average. Please, what you have seen, just comment on what you have seen. Okay, from what you have seen, what can you see? This one is doing better. Okay, what do you think is the reason for the what? For the good performance or the bad performance? Okay, whatever you are going to be saying, you should have something to support it. You should have something to support it. Why? Why do you think these people are doing better? Okay, you can see their capital employed. These people, their investment is what? They are having a low investment as compared to these people. Even though they are having low investment, they are utilizing their investment more than these people. Why? Because if you have 29510 compared to this one, your revenue should be higher than these people their own. Okay, so the reason for this one can be the composition of their what? Of their capital employed. The capital employed for AL is higher than that of what? That of the OL. And that might be the reason. So their capital composition to the asset, that is the AL is having a higher what? Investment as compared to OL. However, OL tends to what? Utilize their investment more as compared to all efficient. They make efficient use of their investment as compared to AL. So what you have seen, 11.65, it means that every 1 cedi that the people are bringing, we are going to be, or every 1 cedi of the existing investment that we have now, we are giving them 11.65 on it. But if you come to that of OL, they are giving 12.65, 12.25. They are giving slightly better than this one. So in terms of return generation on investment, they are doing better than this one. What do you think might be the reason? It is the composition of their what? Of their capital employed. These people are having higher, and these people are having higher. And these people, they are actually having higher of the capital employed. Okay, you come to inventory turnover. Inventory turnover, currently it is taking AL 84 days to dispose inventory whenever they have been what? They have been stocked, or whenever inventory are being acquired, it is taking them on average 84 days to what? To dispose their inventory. It is taking them for 84 days to dispose their inventory. This means that whenever inventory is being bought, on average, they take what? 84 days to convert their inventory, as compared to that of what? That of, or however, OL is taking 93 days to what? To dispose their inventory. So in terms of inventory holding period and inventory disposal, AL is what? AL tends to manage their inventories very well as compared to what? As compared to OL. That is it. What might be the reason? What do you think might be the reason? It might be because of the inventory that they have, or because of the investment that they are making in their inventory. Some of them might be having a slow moving inventory, and some of them might be having a fast moving inventory. If this person is having cars and you are having motorbikes, the motorbikes will be moving more than the cars. Okay. Then you come to the current ratio also. The current ratio, it is taking, currently AL can take what? AL can use their current asset to set up their current liabilities 1.32 times. Okay. This means that if the company wants to liquidate now, the company can actually, or we can say that the current assets are not entirely financed from what? Financed through what? Current liabilities. Okay. So it is taking them, currently they can pay their what? Their liabilities 1.32 times, as compared to what? As compared to OL that is having 1.89. So in terms of working capital management, OL seems to be doing better than what? Than AL, because of their higher margin. What it means is that most of the activities are not financed through liabilities, or short-term or current liabilities. They are using more of the long-term liabilities. So you can look at the liabilities portion over here. So the reduction in this particular one is the result of the composition of their current liabilities. AL tends to use more of current liabilities to finance their operations than that of OL. So what you have seen, what do you think might be the reason? What do you think might be the reason? So that's how we go about the ratio. So what you have seen, please comment on what you have seen. If they ask you to compare with someone, okay, with a comparison, which of them is doing better? Why do you think this person is doing better? This person is not doing better. Whatever reason that you are going to be stating, there should be figure. You should be able to support it with figure. Whatever reason that you are going to be bringing over there, you should be able to support it with figure. Okay, if you are talking about a current ratio, it is a composition of what? It is a composition of their current what? Their current liability and their current asset. So you can actually find the current asset to current liability ratio, which is the same as the 1.89. So it's the composition of their current liabilities. So these people, they tend to have more assets than these people, but these people tend to have less liabilities than them. So their liability ratio, their liability comparison, okay, the current asset to this one ratio, this will be higher. But if you count to the assets, the liability to this ratio, this will be lower. So it is because of their current asset to liability ratio. That is why these people are doing better. That is it. So you have to support your reason with figure. Don't just pick the figures over there. If it is a cost that is bringing it, you can look at the cost to revenue ratio. The cost to revenue ratio. What is their total cost to revenue? So these people are spending this percentage of their revenue on cost, and these people are spending this percentage on their cost. So these people tend to manage their cost better than this one. So you can use the revenue to cost ratio or cost to revenue ratio to back your reason. Don't just go there and be saying that they are able to do advertise, where in the question they are saying that these people are carrying out and promotional activities. You are just creating what? Creating reasons for yourself. They have given you figures. At least try to hammer or try to pick some figures and do your analysis. Very necessary. All right, please. 2 minutes to what? To finish. If you have any issue, you can bring it. If you don't have any issue, this is the end of the consolidation and the ratio analysis. Tomorrow we
Hello,
will
sir.
start.
Hello,
Yes,
sir. I have
please.
a question, please. Hello, sir. Hello.
Yes, please.
Hello.
Okay, please.
Hello,
Hello.
sir.
So
Yeah, who is
the
talking?
question one. The question one on the consolidation. We didn't solve it though. Has it been solved already? The one Paul whose investment is Saul and Abraham.
Yes, it hasn't been solved.
Okay. Thank you.
Do you want to know why?
Hello.
Yes, sir.
If I solve everything now, what will I be doing if I come to power?
Correct.
Hello.
Yes, please, senior.
Yes, sir. Please, in calculating the dividend yield, the figure, the capital, which is the stated capital, which is 3,000, 4,200. Please, if you can highlight it for me.
I should highlight it.
Yes, but I don't know how that figure was got. That's why I said that if you can explain it to me so that.
Okay. You mean explain to?
Yeah, how they got that figure.
Oh, I was coming to highlight the point, this thing for you. Okay. So the share capital, the value of the share capital is 1,500. I hope you can see that.
Yes.
Okay. So each share is what? 50 pesos, isn't it?
Yes.
So the question is, how many shares has been issued at 50 pesos? That gave us what? 1,500. So it should have been number of shares multiplied by 0.5. That will give us 1,500. Because if you want to find the value of a share, it is the number of shares multiplied by the value per share. So we have multiplied 0.5 by a certain number of shares. We are having a value of 1,500. If you want to do this, we divide the share value by the share price. So 1,500 divided by 0.5. And this one will be 2,100 divided by 0.5.
Okay. Thank you very much. I've seen it.
Okay. All right. Okay.
Sir,
Yes, please.
is there rules? Could you also attribute it to the fact that these people, the OAL, they are paying more finance costs, like the cost on their finance that they have acquired?
If you are saying that if I'm part of the people that are matching, I will call your number and tell you what are you paying. Because we are using net profit before interest and tax. Interest has not been taken from the profit. So the impact of the finance cost is not there. We are using net profit before interest and tax. So the profit that we are using is before interest. So interest is not having the impact of the interest is not there. I hope you're okay now.
Okay, but when we're calculating it, we added
the interest back. It means that the interest has been taken away from the profit. So the interest is, we haven't taken the interest from the profit that we are using. Okay, so if you are saying that, then examiner will laugh. Okay, because the interest is not there. So the interest is not taken away from the profit. Okay, most at times it will be the denominator. It will be the composition of their capital employed.
Yeah.
Okay.
Thank you.
All right, you're welcome. If there are no issues, tomorrow same time we will do standards. Have a good evening. I'll see you guys tomorrow. All right.
Thank you, boss.
Okay.